Yo, what is up for y'all on the YouTube replay? I hope you're having a great Sunday. And for the very beginning of the stream, I wanted to go over a stock, ticker symbol TAP, that I think is going to be a great dividend growth company. I do own 13 shares of this company, so I might be biased, but I own them for a reason because I really like them. But let me give you a quick portfolio update. We're also going to be doing another live stream later tonight, right around when the market opens around 8 p.m. So that's in exactly 8 hours from now. So it says 11:45 at the top. I'll probably start the stream around 8 p.m. tonight. But here's my portfolio. Let me give you a quick update. On the day or on Friday, we were up by zero point 0.1. But year to date, since January 1st, we're up 16. By the past year, we're up 22. Here's my total equity in every stock. My largest holdings are at the top, and then here's my total percent change. So luckily, we are up on every stock in here. I can't say the same for my Roth IRA, though. If we switch over here to my $1,900 Roth IRA, here's all my stocks in here, and this is my total percent change. We're down on like CRMD, 11%. GHM. John Deere's a new position I'm about to add more shares of. But yeah, that's our Robinhood account. And let me give you an update now on my Weeble portfolio, and then we'll get into this stock right here that I think is going to be a great performer in the long run. They have a 4% yield, trading at 9 times net income, and I do own them, 13 shares of them. But here's my Weeble portfolio. This is my growth-oriented portfolio. We're only up 15% all time in here, so we definitely have not outperformed the market, but these are all the stocks that we got in here. You've probably heard of a lot of these. Like Robinhood just got added into the S&P 500. So Robinhood rallied up. And you can probably tell the exact second when the news dropped, they got added into the S&P 500. But yeah, I'm super excited to see what happens for Robinhood stock next week. We also have Reddit, SoFi, AMD, Clear Secure. If anyone's heard of that company, it's like in the airports. Supermicro, T Row, Toast. But yeah, let me go ahead. Oh, and then I have to go over my Moomoo portfolio. Yeah, this is my buy and hold account. Yo, what up, Chris? He says grab hood. Yeah, you're right. They just got added to the S&P 500. Great news. So much passive money. A lot of people, when they get paid every month, set a little bit of money aside for retirement, put it into the S&P 500. And now some of that money, every time they put some in every month, is going to go a little bit of it to Robinhood. So that's good news. But anyway, here's an update on my buy and hold portfolio. This is my portfolio where once I buy a stock in here, I try and never sell it. I've only sold like 2 stocks in here, Nike and CubeSmart, but these are all the stocks that I've basically had forever. I've never taken a single share of profit. I've never trimmed a single position. Yeah, all time we're up $7,700 in here. We do have 1,000 of cash ready to buy the dip. And Lucas said, "Do you own Google? And if so, what's your return?" Yeah, I like being fully transparent. I do own 19 shares of Google. Luckily, they are at an all-time high. They're up 48% the past year, and I am up 44% all time. It is a $4,000 position for me, 19 shares. But yeah, I love Google. We can go over them in a second here. But let me go over real quick just one stock that I do own that I think is a very nice dividend growth company. So, check this out. I guess there's some sort of technical analysis. There's a bearish flag. Okay, that's not good, but that's a technical analysis. Let me give you my analysis when we judge them off their financials. So first off, you get a 3.6% dividend, and that is only a 33% payout ratio for them. Like McDonald's, for example, has a 2.5% dividend and a 50% payout ratio. So this is very undervalued. They're trading at 10 times net income. The industry average is a 15. They're doing insane share buybacks. So one reason the stock is falling or has a low multiple is because the business isn't growing. Like the sales actually declined 1.5% year over year. But this is the best news. The fact that they're making a bunch of net income. Check this out. They made $430 million in net income in the most recent quarter. Let's go see how much the dividend cost. You go to the cash flow statement, and the dividend, their 3.8% dividend only cost $100 million of net income a quarter. They could pay for their entire year of dividends just in the most recent quarter. And since they have so much leftover money, they're spending a couple $100 million, near $500 million a year solely buying back their own stock. Here's what that does for you. So yeah, the net income fell by 0.24, but the net income per share actually grew by 5% because there's 5% less shares that exist from the previous year. So now we know they have a sustainable 3.6% dividend that they even have room to raise it. They have a very nice share buyback program, but the one do beware of that the sales are declining a little bit, but they are cyclical. This is a drink company, by the way. So TAP owns a lot of brands you've probably heard before. Pretty cool. You sold Nike. You said I did sell Nike. Here, I'll actually pull that up. If I sold a stock, it would be a sell order, and I sold all my Nike at $79 a while back. So this company, they're unfortunately they lost their growth. So I'll be quick about this. But the sales fell by 12% year over year on Nike. So sales are down by 12, but net income fell by 85%. They couldn't even afford the dividend this quarter, unfortunately. They made $200 million of net income. Again, if we go to see how much the cost of the dividend, they have to at least make $591 million just to afford the dividend. So that's one thing I am being super careful with about Nike. One thing I will say, though, it looks like the worst is over for the company. They gave some good upbeat, better than expected guidance. So I think that only the numbers aren't going to be as bad as they are today, or they shouldn't ever be. Hey, what up, Cruz? Hope you're having a great Sunday. What's up, man? He said BROS. Let's do it. Dutch Bros stock. So this is like a Starbucks competitor. Dang, they fell 7% on Friday. I do wonder if there was any specific news. Maybe it was just a bearish Friday momentum or something. But one thing I like about Dutch Bros is how they're growing right now, and they're beating analyst expectations as well by good chunks on every metric. So first off, their company operated shop, so the shops that the actual parent company owns, is up 28% year over year after growing 33, after growing 37. So they're continuing this very nice growth, 400 million of sales nearly this quarter. Also, they have their franchise revenue, which this is all high margin fees they collect. The franchise fees were up 19% year over year to a new record as well. So both main segments of business are growing. Sales are up 27, net income's up 73. So that means they're expanding their net margins, near 10% net margins. That's really good for a restaurant. And at this growth rate, what's it going to be this time next year? They might even grow it even more. So Dutch Bros is actually pretty interesting. I think they're honestly, I think they're a better buy than Starbucks. But yeah. Wait. Yeah, so that's Dutch Bros. How is JEPQ dividends? I don't trust anyone who uses Robinhood. Okay, I love Robinhood, dude. Robinhood is a $100 billion S&P 500 company that people are really starting to take serious. They're not just some irresponsible brokerage who, whenever gets a call from Citadel to remove the sell button or the buy button on GameStop, they wouldn't do that anymore. But let's keep going. Someone said, does Webull do technical analysis? No, it doesn't. It doesn't, Taryn. Actually, I'm not on Webull. This is Webull right here. Yeah. Let's see. Someone said Lululemon, NextEra Energy. Wait, Isaiah said, I've been researching NextEra Energy. I want a second opinion before buying. So, yeah, then we can look at Lululemon. They just tanked 20%. But here's NextEra Energy. This is the largest utility in the world. They literally own, if you live in Florida, there's a high chance your utility bill is through this company because they own Florida Power and Light, which is a utility. Every utility company is like a local monopoly, but this revenue is just from Florida. They're making $4.7 billion every 3 months just from the state of Florida. So they're a huge Florida utility company. You get a lovely dividend. They're a regulated utility, so even if customers aren't paying, the government will give them that return anyway. That's what's so interesting about regulated utilities. They should just return 6-7% a year. But look at this. You also get a 3% yield. That's very nice. 3% dividend, 61% payout ratio, so the dividend is safe, trading at 24 times net income. That should be fair for industry average for utility is 18, but they are they deserve a premium. They're the industry leader. So they had a one-time adjustment last quarter. You see how it says they only made $464 million. They actually made closer to $2 billion in net income. So the PE ratio we just looked at, 24, it's actually artificially high. It's probably closer to like a 21. But anyway, yeah, they have a very safe and sustainable 3% dividend. I'd buy and hold them for the long run. These regulated utilities, if you go to ticker symbol VPU, it's such a safe ETF. It legit just returns on average like 7% a year. And you get the lovely dividend. And if we go to this ETF right here, the largest holding is actually NextEra Energy. Then it's Constellation Energy. Southern Company is another great one. They own Georgia Power and Light. They have a 3.2% yield. Okay, so sorry. Let me go to the next stock. So, hey, what up, Doctor One Fly? No way, brother. Good to see you again. Thanks for all those gifts, dude. You sent like 20 roses. No way, dude. Thanks so much. If you got a stock you're gonna look at, let me know, my friend. And also, Invested '09. Thanks so much for the dolphin, dude. I do appreciate that gift. So let's look at Lululemon right here. There was some bad news on earnings. They fell 20% because their North America sales growth was only up by 1%. That's not great. The North America sales were up by 1%, but the international sales at Lululemon were up by 25%. So when we combine those two segments together, the total sales were up by 6% year over year. Disappointing North America results, but they have, hey, what up, Louis? Yeah, well, check out GCT. So check this out. The revenue grew by 6.5, but the net income declined by 5. So their margins did fall by 11% year over year. I honestly think that this one might go a little lower. I think it probably needs to trade at like 10 times net income. They're trading at 11.5 times net income. Their number of stores are 784. Okay, they did open some new stores, but we do need to watch the margins for Lululemon. One thing I do like about Lululemon is the buybacks because they make a couple hundred million in net income a quarter. They don't pay a dividend. So what are they doing with all this money? Well, this is the money they're spending solely on buying back their own shares. Like or actually more to like 300 to 400 million a quarter, solely buying back their own shares. Unfortunately, all those shares they bought back were poorly timed because they could have bought back with that same money 20% more shares than they did because they fell 19% on Friday. So that was unfortunate. But I do like the buybacks because the net income fell by 5.6, but the EPS, net income per share, only fell by 1.6. So that's pretty cool. All right, Louis said GCT stock. This is, Giga Cloud Technologies. I do have this company on my watch list. They are a bit of one of the riskier ones that I wouldn't have as a huge position, and this is why, because if you look in the top right, the market cap, they're only worth $1 billion. So they're exactly $1 billion company. They're pretty diversified. Off-platform commerce, Giga Cloud, last mile delivery service. That grew 4% year over year. So I don't really know what this company does. It looks very diversified, like packaging, ocean transportation. I don't know, but so the sales are up by 3%. I guess it's tough to compare it to because they doubled from the previous year. So sales are up by 3. Good news, they're making net income every quarter. That's actually great news. Only worth $1 billion and they're making, yeah, so they're trading at an 8-time PE. They're trading at 8 times net income. Are analysts expecting them to continue this net income positivity? They are. So, and they're beating on every metric. This is great news. I like Giga Cloud. Still be careful. They're only worth $1 billion, but they seem really interesting. If you didn't know, all right. Let's see. ZS stock. What up, robot? That's Zscaler. So this is a cybersecurity company. Yeah. Hey, by the way, I don't sell anything. That's not me. I don't have a course book, WhatsApp, Telegram, Discord. I'll never follow you, DM you. That's not me. If you want to help me out, though, just hit the like button, hit the subscribe button. But here's Zscaler. But yeah, this is my only account. I have a YouTube channel, but this is my only TikTok. But check out the sales. This is what's so cool about Zscaler. They have incredible growth. Like, check this out. I mean, it can't get more consistent than this. It just hits a new record every year, every quarter. If you look at it on an annual basis, I mean, in 2019, it was 300 million. Now it's 2.17 billion. Just in the most recent quarter, it was 678 million. So these growth rates in the middle are very impressive. Are they getting close? So they're not making net income yet. Do beware, they're not making net income, but they're barely losing any money. It's no big deal. I'm sure they're printing free cash flow. Yeah, a couple hundred million of free cash flow. They beat on revenue. So analysts were expecting them to kind of continue to lose this net income. That's all right. So yeah, Zscaler is a cool cybersecurity company. I don't know if they're in the S&P 500. They probably are. Pretty sure they are. What brokerages? Yeah, what up, Karen? So yeah, if you want to get this app I'm on, it's actually a brokerage where you buy stocks. If you want to get it, it's in the link tree in my bio, the very first link there. But yeah, or you can, thanks. Yeah, or you can just type it into YouTube. It's just a brokerage called Moomoo, or type it into Google. Sorry. All right. So what up, Alaska? So let's see here. Someone said bear or bull for AMD upcoming week. So let's look at AMD. Oh, then we can look at SoFi, Duolingo. Yeah, sorry, I want to get to all these stocks here. I try and go pretty quick with each one. So I do own AMD actually, full disclosure. I got 11 shares of them. They're my second largest holding in here. So I have 11 shares of them. And I think, honestly, it's a tough buy right here, even after the 6% buy. I wouldn't be making this a meaningful position at this price. But here's what I love about AMD. They have a huge GPU market share, obviously, a 17% PC GPU market share that goes to their client and gaming revenue. Client and gaming revenue increased 69% year over year. The data center business has been growing very nicely. Data centers need GPUs, and AMD makes their own GPUs and can supply them themselves, the cheapest and the quickest. And check out what that's done to the FCF, which stands for free cash flow. This is incredible. $1.7 billion record free cash flow quarter. That's so impressive. And not just free cash flow, but net income as well. Near 900 mil in net income. The growth is finally back. Sales are up 31%. They have an absolute fortress of a balance sheet, my friend. So no net debt on them. Cash flow numbers are great. So yeah, for those reasons, I do own AMD. I like AMD because if you look at this market cap, the whole company, this is big, but it's worth $245 billion. Okay. For you to double your money, they have to go to around a $500 billion market cap. But if we go to Nvidia right here, which is, if you look in the top right, is worth 4.06 trillion. If you buy Nvidia right now, the market cap has to go to $8 trillion for you to double your money. So I think I want exposure to chips. So I chose AMD over Nvidia. That so far hasn't really been the right move because Nvidia would have been the better buy. But AMD has still done pretty good on it. Okay. Let's see. Oh yeah, Duolingo. I love this stock right here. I think AMD retrace 130. Yeah, I could see that happening. I got in at 125. It might even go back to 125. I don't know. If it does, I'll probably that's the real gold spot. 125 to 130 is where you want to probably start to buy. So here's Duolingo. This is that language learning app, and they're not doing too great right now. Or yeah, the stock's not doing too great, but the actual financials are doing great. It's just the thesis that's really being hurt here because ChatGPT or OpenAI made a competitor to Duolingo, another language learning app. Google has one as well. But for right now, the business is doing fantastic. They have the subscription you pay for. If you have a Duolingo, you have to pay for the subscription or you see a bunch of ads. And look at that. Look at the subscription revenue growth in the middle. It's so consistent, up 46% year over year after growing 51, after growing 46. Like you could just see it just hits a record every year, every quarter. And it's not just the subscription revenue, but the advertising revenue is up 55% year over year. So both businesses are growing very nicely. Sales are up 41, net income's up 83, so that means they're growing their net margins. 17% net margins, that's a record margin quarter for them. Free cash flow is up 60%. They're going to be making $100 million in free cash flow quarter. They just deleverage completely the balance sheet as well because assets go down with liabilities. So you focus on this ratio right here. They deleverage from 65 to 36. So everything in Duolingo financially is headed in the right direction, and that's why I think that one's worth looking into. Put them on the watch list and see if they go lower to maybe buy them. I even like them right now. I think it's worth putting putting it as a very, very small position today. All right, so Nvidia's at 4 trillion. Yeah, knuckle. Isn't that crazy? What up, Gabe? Why is your portfolio so diversified? Yeah, I probably have too many stocks. So, what do you think of? There's so many good ones here. Yeah, hey, I don't got anything good to say about Rich Tech Robotics. That's not a good one, Jackson. I don't like RR. Should we do Adobe? Okay, we'll go over Adobe because the software names have been getting crushed recently, like Salesforce, Adobe. I honestly think Adobe is worth probably $400-500. I think it's undervalued, but because I think for art and stuff, we still need that final touch. Like AI will never be perfect enough. I still think we need software. I think Adobe, I use their products daily. I'm on Photoshop, After Effects near daily. Don't tell Adobe though, but I kind of got the pirated version. Okay, but check this out. Here's what I love about Adobe. The fact that they're still growing. Sales are up double digits, sales are up 10%. They're printing net income 1.7, 1.8 billion of net income every quarter, after tax net income. The free cash flow is even better. They're making over 2 billion of free cash flow a quarter. So what is Adobe doing right now with all this money, this retained money because they had 2 billion left over of cash. They're just spending all their money right now buying back their own stock because they know it's undervalued. They spent 3.5 billion solely buying back their own stock. They could have bought a company with that amount of money. A lot of stocks I own are worth under 3.5 billion, and they spent 3 billion the quarter before. So this is what they're doing right now, buying back so much of the company. So if we look at the net income is up by 7.5, but the net income per share is up by 12.9. That's because the share part of the ratio is down so much. I think Adobe's worth buying and looking into, not financial advice, of course. All right, what up, Alaska? Let's look at Google, man. Yeah, so Google stock all-time high. Congrats if you've ever owned this one because you got to be up. Yo, John, what's up, dude? Thanks for joining the YouTube stream. I appreciate that. Yeah, if y'all want to support me, best way to support me is just watch the stream from YouTube. I'm trying to build up my YouTube channel. My YouTube channel is called Nathan Robert. It's also in the link tree in my bio. But you can just type into YouTube Nathan Robert. Also, I sell nothing. I have no course, book, Discord, WhatsApp, Telegram, nothing like that. So here's Google. This stock's at an all-time high. I do own them, so I might be biased, but here's why I'm not selling them. Like if I go to my shares real quick, I own 19 shares of Google. I'm up 44%, and here's why. I haven't sold a single share ever. I have not trimmed a single share. Here's why. Because I think they're going higher. Because right now they're trading at 25 times net income. That, for a Mag 7 company, that seems pretty fair. So pretty fair 25 times net income. I feel like it could stretch out to like a 27, 28 before it really gets overvalued. They're legit like an ETF in one. They own the Google Cloud, Google Search, YouTube, Android, Waymo, quantum chips, TPUs. They're just a legit monster. And check this out. The sales are up by 13%, but the profits, the net income is up by 19. That means they're expanding their net margins, near $3 trillion company with 30% net margins. So what is Google doing with 20 to 30 billion of net income a quarter? Well, check this out. They just started recently paying a dividend, and the dividend only cost them 2.5 billion. So they have so much future potential to raise their dividend. I think this is going to be a great dividend growth company. And since the dividend only cost 2.5 billion and they have so much leftover money, the real winner is the buybacks, man. If you notice one thing about my portfolio is that I own near every stock I own is buying back their own stock. And I need to just make like a free lesson on how important buybacks are for total shareholder returns. It legit forces the stock price to go up whenever they buy back their own shares. There's less shares that exist, gives you more ownership in the company. It makes the dividend cost less, it makes the EPS go up faster than the net income. Like, check this out. The net income grew by 19.4, but the net income per share is up by 22.2 because there's 3 to 4% less of the shares that exist, and they do that every year. So yeah, yeah, I'm still waking up here. Well, not really. I woke up a couple hours ago, but I need coffee. Thoughts on Chipotle? Ooh, let's do it. Oh, someone said Vertiv. Had your lunch? No, I've not eaten nothing today because I'm getting Panda Express later. So, Chipotle stock. Let's do it. Then we'll look at Vertiv. What up, Clem? What's up, man? Have you read Intelligent Investor? I've not read that. Uh, but so I'm sure that's a good book. So here's Chipotle, CMG. This, we've all heard of Chipotle. They're like a restaurant, like a healthy restaurant. Here's why I think this one might actually go a little bit lower. Here's the thing. So if we check out this company's, sales, the growth of it, the sales are only up by 3% year over year. And if we look at the net income multiple, this company trades at 36 times net income. And it's okay to have a high premium, high valuation, but you got to have high growth. And this one's tough because the sales on Chipotle are only up by 3% year over year. That pretty much matches inflation. And also, bad news, the sales are up by 3, but the net income actually fell by 4. So that means they're losing their margins a bit. Net margins down by 7. But they're still printing money. Near 400 million of net income a quarter. In no way. In actually no way. Yo, shout out to Cruz on the YouTube stream. I actually don't believe it. Largest donation I've ever received. A $19.99 super chat. Yo, shout out to Cruz, bro. He says Panda Express on me. Bro, thank you so much, man. I'm gonna get the orange chicken and chow mein. I really appreciate you, Cruz. That you just made my Sunday. Thank you so much, Cruz. Uh, so hey, if y'all want to support me, best way go watch the stream from YouTube and say shout out to Cruz. Thank you so much. So, have I made any purchases recently? Yeah. So, John, I actually just made a YouTube video about this stock right here. It's a recent stock I bought here in my Roth IRA. This is ticker symbol CRMD, and I'm about to make a pitch for this stock. Why I think, not financial advice, this is a 3x potential. And do beware, I am down 11%. And as much as I believe and hope that this is a 3x potential, I cannot put a meaningful size position in this company. That's a $200 position for me. But let me share with you why I think this stock is legit a diamond in the sand. Okay. So check out the market cap. I normally would never recommend these kind of stocks. Like the whole company is worth $929 million. So think about that. The very small company, they're only worth $929 million. But here's why I think they're worth looking into, because they have no debt whatsoever and $190 million of cash. So think about that, for example, for a second. 19% of the entire company's market cap is their cash on hand. That's a huge safety net that gives them so much freedom, no debt on the books. 19% of the entire market cap is just cash. So whenever we do a net income multiple, we really subtract, we take off 20% because 20% of the market cap is just cash on hand. But here's why I think this is the best buy. They're right now the best buy they've ever been, because a year ago they had no sales, 70,000 or 20,000 a quarter. But now it says it's 39 million in the most recent quarter. And here's the best part. Added this 39 million revenue, 19 million of it was net income. So here's a company that's going to be making, over 100 million of net income a year, pretty much. According to the analysts, if we go to this EPS right here, in the sales as well, the sales are 39 million, a record this quarter. It's supposed to be 100 million in 2 quarters. And if we go to the EPS is expected to go from 28 to 65. And remember, 28 cents of EPS equals 19 million. So they're expecting near 50 million of net income just in 1 quarter. So that's why I think this one is legit. Should not financial advice be 3x higher? Do beware, this is a healthcare company. They sell this only one product right now. They only sell Deaf and Cath, and 60% of the sales come from one hospital group. So basically one customer. So they have some customer concentration, but they just acquired a company that adds 7 more products to their portfolio. So they're pretty interesting. I actually just made a YouTube video about them. It's my very most recent YouTube video, if you want to check it out. It's the 3rd stock I go over. The first one I go over is Google. But I think it's a very great video. Not financial advice, of course. Nothing. Hey, I sell nothing, by the way. No course, book, Discord. So yeah, I will never follow you or DM you. Yeah, I keep seeing people saying, "Is that you that just DM me on on the second account?" That's not me. I'll never follow DMs. Yeah. So here's SoFi Technologies, and thanks again, Cruz, my man. Thank you, Cruz. So SoFi Technologies is one I do own, by the way, and I own not much of them. I regret every share I've ever sold of SoFi. I sold them a while back. Some of my position, I still got 24 shares left. I've been in this company for legit like so long. Here's where I bought all my shares, but here's what beat even my expectations. They blew away every analyst's expectations, because if we go to their financial services revenue, it's up 105% year over year. After growing 79, after growing 222, I can't believe the growth, and not even analysts expected this. And shout out to Louise Estrada. No way, Louise. Thank you so much for the 45 roses. If you got a stock you want me to look at, let me know, Louise. I got you, brother. And Invested09. Thanks again, dude. You're always in here, Invested09. I appreciate that. So yeah, the financial services are legit at a record. I can't believe it. Companies with high growth like this, super growthy companies, they should get slapped on a higher PE than your average Joe Schmo company. And also the lending revenue is also up 30% year over year, also 2 new records. So both main segments of business are growing like crazy. Financial services are up 105, and also their technology platform is up 15%, also to a record. That's cool. But people are really starting to take SoFi serious because they're making a lot of money. They made 100 mil of after-tax net income this quarter. So they're actually making net income every single quarter. When if we zoom out, where I was buying them, they were losing net income every quarter. But people can really take them serious now. They're super growthy. Sales are up 42% after growing 20, after growing 37. I just really like SoFi. I might be biased though. So that's why I think there's them being at $25 is actually justified. So very nice. So Invested09, thanks again for the roses there. He said BMNR. So this is Bitmine Intermission. So this is basically just an Ethereum staking company, Ethereum holding company. Tom Lee works for them. If anyone knows who that is, the Permable. So basically, you just trade this company off their net asset value of their Ethereum. Yeah, check this out. So revenue from self-mining, revenue from sales of, so basically think crypto here. This should kind of be an Ethereum proxy from what I see. I wish I could give you more thoughts on them, but I think they're just an Ethereum holding company. So MTZ said Build-A-Bear fundamentals. So this is actually very surprising. So ticker symbol BBW. This is Build-A-Bear Workshop. So they're actually surprisingly a good buy, not financial advice. They will get hurt in a recession, very cyclical. But check out this market cap. Here's what I actually used to own them. I actually kind of regret selling them now. I made a good chunk of money on them. Well, not like 20% on like not much money. But check this out right here. I actually have a few YouTube videos about Build-A-Bear Workshop, but check out the market cap up here. Here's why I think this one's worth looking into. They're an $850 million company. So, wow, look at that stock chart, dude. This beats NVIDIA. This was a $5 stock. Now it's 64 schmeckles. And they're only, even after that huge rally, they're only worth 850 million. So they must have been worth legit like 40 million bucks down here. That's crazy. Anyway, here's why I think that $850 million market cap is justified, because they're making net income every quarter. So out of all the $850 million market cap companies, not all of them are making this kind of net income, 10 to 20 million of after-tax net income a quarter. Also, the balance sheet's pretty decent. Let's see how much cash. 39 mil of cash. I know they just started paying a dividend recently. So yeah, you get a 1.3% dividend yield. They do share buybacks. Let me see. EPS. Wow. They have bought back 7% of all the shares. So let me actually go verify that. So if we go to the cash flow statement, so remember, the whole company is only worth 800 mil. So when they spend 10, 20, like 30, 40 million, that's 5% plus of the company. And the dividend only costs. So here's the dividend. They need to make 3 million a quarter for the dividend. And then since they have leftover money, they're just buying back their own shares. So pretty cool. What's the growth though? Sales are up 11. Not bad. So yeah, that's Build-A-Bear Workshop. Can't believe going over them. So Louise, thanks again for all the roses, dude. He said, I'm watching GameStop earnings. I hold 20 shares. So thanks again, Louise. Let me check out this company. And hey, Remco, RG, what's up, guys? And we'll look at IPOs after this. XPEN for AppLovin, Rocket Lab. Yeah, we'll check that one out too, Aaron. We'll look at Rocket Lab. So here's GameStop. So there's only one thing I'd really watch for this company. And there's one thing that really interests me. So remember this market cap. We'll just round it down, $10 billion. So the whole company of GameStop is worth $10 billion. Here's what's so interesting about that. This company has no debt at all and $6.4 billion of cash. So legit, 64% of the entire market cap is their cash on hand. Isn't that crazy? And they're also buying a bit of Bitcoin with this cash. But here's also how they got that cash. If you go to the cash from financing activities, if this is positive, this means they either diluted you, they issued shares, or they issued debt. So you don't really want you don't really want this to be positive. You want it to be negative. That means they're like returning money to the shareholder, but they diluted you by $1.5 billion this quarter, $3 billion this quarter. That's how they got this cash. Because if we go to the actual fundamentals of the business, you wouldn't buy this one from a fundamentals point of view. I mean, sales are down 17 after falling 28. Like, you're not buying them for the actual GameStop stores. You're kind of just buying them for the momentum. You're buying them for the cash on hand in the hope that Roaring Kitty tweets something again. Not one I own. It's too meme momentum-y, because whenever the stock does go up, they always dilute you just to raise cash. But they do it in a smart way to fortify their balance sheet. I don't blame them. So Anyway, that's hopefully that was helpful. Invested '09 with the more roses. Thank you so much, my man. What up, Lulu? So Labubu stocks. What is that? So okay, someone said IPOs. So there are some new IPOs. I'll be super quick about this, but yeah, Gemini. Figure and Klarna. Klarna should be interesting because this is a buy now, pay later stock. If anyone's heard of a firm just had killer earnings. So I'm curious to see what will happen with Klarna. Also, do beware if you buy them before they IPO, if you click I'm interested and want to buy the stock, look in the middle of my screen here. It says I'm aware of the flipping policy. If you buy them before they IPO, you actually can't sell your shares for 30 days or you'll be restricted from buying future IPOs. But I will say, and this is unfortunate, but one thing right now, a lot of companies, and you've seen this with a lot of IPOs recently, they purposely IPO at an undervalued market cap. That way they just rocket up instantly as soon as they IPO. You've seen that with Figma, Bullish, Weeble, a lot of IPOs recently, CoreWeave. So anyway, let's go back here. So those were the IPOs. Klarna looks interesting. So, yo, what up, Remco? He said, thoughts on EXPN. Is that Experion? Wait, EXPN. I type in that ticker symbol, and unfortunately, I can't view that one on this exchange, so I do apologize. So here's AppLovin. This company, I believe, just got added into the S&P 500. So did Robinhood. That's why they're up 6.5% after hours. So if you own the S&P 500, you now technically own a little chunk of this company. And I believe they deserve to get added into the S&P 500. This is a phenomenal company with phenomenal growth. I almost don't believe it. It's so great. I mean, the sales are up 77%. And out of this 1.26 billion of sales, 820 million of it was net income. The margins are absolutely like ridiculous. Reddit type margins, 65% net margins. So if you go spend $100 at this company, $65 of it is after tax net income for them. They're expanding their margins. Already 43% net margins was already extremely impressive, and they grew it to 65. That's why they deserve to be at all-time highs. I mean, I don't think analysts were expecting that. Also, free cash flow is ridiculous. 800 mil of free cash flow. And at these growth rates, that's the thing. At this growth rate, what's this net income going to be at the same time next year? That's why you slap on a high multiple because they're extra growthy than your normal company. So AppLovin's very cool. It's tough chasing them after they're in the S&P, but very cool. I wish I owned them. So someone said Rocket Lab. This is that space company. It's honestly probably my favorite space stock out there. I like it more than ASTS. I like it more than LUNR. But they just finalized their Geost acquisition, which is great news. That should add even more growth to the sales. So here's what they do. They have their space systems revenue right here. It's up 27% year over year after growing 94. So I mean, these growth rates in the middle are so impressive. You can kind of just see the growth here, and not just the space systems revenue growing, but also their launch services are up 58% year over year to a new all-time record, actually. That's a record amount of sales for the launch services. Plus, we're adding the Geost acquisition in the future, should add even more growth to the sales. But do beware, though, they are a money loser. They're losing around 50 mil a quarter. That's honestly not that much. Well, 50 mil a quarter, we do want to see this trend start to improve a little bit. It doesn't matter for right now because of how growthy they are. So Rocket Lab's cool. I do like them. Okay. Yo, what up, Mikey? How's it going? Yeah, happy Sunday, by the way. TSSI, yeah, let's do it. What about YAAS? BJ's Restaurant. Yo, I'm pretty sure you're talking about, aren't they a grocery store money? What's the ticker symbol for that one? So, what company? I forgot what company I was talking about. By the way, if you missed anything, I'm streaming on YouTube as well, and you can like rewind. It's on there forever. You can replay it. And my YouTube channel is called Nathan Robert. It's also in the link tree in my bio. I'm streaming on there as well, and it stays up there permanently. You can rewind. Sometimes I talk too fast, and I apologize. But and by the way, I sell nothing. I have no course book, nothing. So here's TSSI. Here's a very small company that might be worth looking into. So check this out. They're worth $372 million. So remember that the whole entire company is worth $370 million. I normally don't like these kind of stocks, but out of all the $370 million companies out there, I love this one because they're making a couple mil every quarter. So they're net income positive, and they're super growthy. The sales went from 12 mil to 43 mil. These year-over-year growth rates are very strong. They're a bit leveraged, beware, but I like the direction they're headed in. They're making net income every quarter. They did, I think, miss on. There's no since they're such a small company. There's no analyst covering this stock right here. But TSSI, as much as I like them, I wouldn't put a huge amount of money in that stock. I'd keep it as a very small position. That's I have those in my Roth IRA kind of. I have the like InnoData, GHM, CRMD. That's my most recent purchase. I just made a YouTube video about them if you want to check it out. DCTH. And as much as I love them, I only keep them as small little $100, $200 positions. So, okay, what app is this? Yeah, hey, you're talking about this one. This is my favorite app right here. Lowest fee, my most useful brokerage, in my opinion. If you want to get it, it's in the link tree in my bio. Very first link there. It's a brokerage where you buy stocks on. So, yeah, link tree in bio, first link. It's an affiliate link, full disclosure. So if you sign up on deposit, we'll both actually get a fractional share of like NVIDIA. So, okay, so Remco said, Mike, can you check out URI, United Rentals? So my brother, that is I think it's my best performing stock in terms of total money. So if I go to total return in terms of money, yeah, URI, I am up $1,700 on this stock right here. They've been an absolute monster of a performer for me. Actually, let me show you my shares. I'm up 56% on them. So this has been one of my best performance stocks. And it's a super boring company. It's always the super boring stocks that make a lot of money. Like this stock right here. All they do is repair roofs, McDonald's. So self-storage company. So here's United Rentals. All this company does is rent stuff out to people. They rent out like from forklifts to trucks to porta potties. They rent out anything. The specialty revenue has grown very nicely. In this high interest rate environment, it's been very favorable to rent instead of own. So anyway, normally this is what's so weird. You look at this stock, they've had like insane performance. You wouldn't normally see a stock like the net income is down 2% year over year. Sales are only up by 4%. The margins fell year over year. You normally wouldn't see this kind of stock go to all-time highs, but there was a new tax change in the most recent beautiful bill, whatever it's called. The big beautiful bill, where you can instantly write off the like accelerated depreciation, and it's been so beneficial to their future taxes. But anyway, this company's so shareholder friendly. They're spending so much money solely buying back their own shares. They're legit spending $300 to $400 million every quarter of their after-tax net income buying back their own stock. And the dividend only costs $100 million. So since the dividend only costs $100 million, that's why they're spending their extra money on share buybacks. Anyway, United Rentals is a great one. I wouldn't buy them at this price, but I think they're going 1,000 plus. Did you see Hood getting in the S&P 500? I sure did, because I'm a shareholder of Robinhood, by the way. I regret every share I've ever sold to this company. But yeah, you can probably see on the chart where the exact second the news dropped, they got added in the S&P. So yeah, great news from Robinhood. I do own them. All right, let's see here. BJRI, let's do it. BJRI, BJ's Restaurants. So, okay, I didn't know this was like a separate company. So this is a very small company. They're only worth $740 million. And the stock is the same price that it was back in 2010. So yikes, for like 2 decades, they've been flat. That's unfortunate. So let me go see how they're doing though. So the sales are up by 4% year over year. So single digit growth. Not great. So sales are up by 4. They are, well, it's a bit choppy. Like they made net income these 2 quarters, but then they lost net income these 2 quarters. And they're just not making much money. Like they can't really make more than this amount of net income. So to be honest with you, nothing's really blowing me away here on, do they have a dividend? They have no dividend. They had to cut it in 2020. That's all right though. So I would just be careful with that one. There's other restaurant stocks that look a lot better in my opinion. My bad. Yeah, sorry if I don't get to your stock. I do try and get to all of them pretty fast here. Just want to say I really enjoy your live streams. Hey, thanks so much, John. I really appreciate you, man. Thanks for always showing up here. So SPRT is also forming an inverse. Yo, but we can check that stock out too. So here is Grab Holdings. So this is legit. An Uber, not really competitor anymore, because if we go to the largest shareholder, 13% of the entire shares are owned by Uber and 5.5% is owned by Toyota Motors. So They're kind of backed by Uber. This is why it was genius for Uber to buy this stock. If you're wondering what they do, they legit do exactly what Uber does, but in all these other countries. So notice the US, Canada, UK isn't on here. It's all these more international or more like these other countries like Singapore, Philippines, Vietnam, Indonesia. So it gave Uber instant international diversification, which I think it was genius for them to buy. But also, that's good news for this company because they're now making net income every quarter. They've made over, you know, 10 million every quarter for the past year. The free cash flow is very good as well. Let me see. Yeah. Oh my goodness. So sorry. Let me get my water here. So yeah, Grab is pretty cool. They also have no net debt, backed by Uber. Okay, sorry. Oh yeah, what up, Clem? I forgot to get to this stock. My apologies. So this is Vertiv, VRT. I don't remember what this company does. I believe they're like a kind of maybe like a super microcomputer. I don't remember, but we can just check out the financials here and we can see that they've been very growthy. The products revenue is up 39% year over year. That's a record sales on their products business. So product sales are at a record. Also, the services and spares revenue also at a record, up 20%. So both businesses are at a record. They're beating on analyst expectations, like the orange lines, what the analyst expected. You know, S&P Global data. They beat on revenue. They beat on net income. They beat on EBITDA. So I'm not shocked why they're doing so well. And look, these net income numbers are great. They're making like 200 to 300 mil of net income every quarter. So Vertiv, I can understand why this one's been so growthy. Wow. I hope Uber fails. Uh-oh, that's not good. You know, one thing about Uber, they're so inconsistent. You know, Uber, they're resetting the like reviews on some people. Like, you never know if the person in the Uber is not going to turn on the AC because he wants to save $1. I don't know. Anyway, all right, brother, you keep your cash in Moomoo waiting for a dip. So yeah, if you look in the middle of my screen, you're right, John. Yeah, I have $1,000 of cash right now. I'm ready. I'm waiting for a dip. I'm ready to buy the dip. I think it's smart to have a little bit of cash on hand, especially with how stretched a lot of companies' valuations are. There is some stocks that are worth buying at right now's valuation. Maybe not as they won't really outperform in the long run. But hey, if you go to the very beginning of the stream, let me know if I should repitch this stock. I'll do it again if you guys want me to. I spent like a couple minutes going over TAP stock. I think this one is like a diamond in the rough, a great stock. I think PGR is another great stock to buy right now. SFM, Sprouts Farmers Market, healthy grocery store with insane margins for a grocery store. So those three I'm looking into as right now buys. But if I go to like some of these stocks right here, like some of the more growthy names, I wouldn't buy almost like this entire list at these valuations. I wouldn't buy Reddit here, Robinhood, SoFi, well, maybe AMD a little, but not much. But Futu, Dave, Supermicro. I wouldn't buy Supermicro here either. They're probably going a little lower. So let me go back to the liquid cooling for chips. Oh, okay. Oh yeah. My fault there. SRPT. Let's do it. Then we can look at um um what QYLD? Yo, QYLD, that's a covered call ETF. We'll look at ULTY too. So here's SRPT. So unfortunately, if you're wondering why did this stock just take this insane decline, if you didn't know, they have this prescription right here, Elevidus, whatever this is called. Unfortunately, legit, two people took it, or some people took it and two people passed away. Like legit, super sad. And the stock tanked. Like that's why the stock right here on this day, there was no earnings, but the stock tanked because that's the day someone passed away. So basically, the sales are going to plummet in the future for this product. We can kind of see that sales are going to go from 650 to 350. So I would be careful with this company right here. The sales growth have been great, but they're about to decline. So do beware of that. That's why. So this one, I'm just avoiding just because of the severity of what happened. Because honestly, they could be oversold and this could be overdoing it. And they have other prescriptions and other businesses and stuff. But I'm just avoiding that one. So, okay, here's one of the covered call ETFs. QYLD. So here's the thing with these ETFs right here. So as you can kind of see, these don't really outperform the actual QQQ in the long run. So this sells covered calls on the QQQ or the NASDAQ 100. And as we know, the NASDAQ 100 is at an all-time high. But as we can see, this one is, this was in 2019, 23. Now it's 16. So you've lost almost half your money just in terms of the stock price. But you basically buy this to maximize your dividend income because look at the dividend. It's a 13% yield. As you can see, the dividend kind of trends slowly down every year just from net asset value erosion and the high expense ratio fees. But you're basically buying this to maximize your dividend income. You get that monthly payment, but the stock price is something to be aware of. Like, yeah, you get the nice dividend, but you got to add back in the money you lost from stock price decline. And when you factor those two in together, plus taxes, expense ratio fees, you're actually not outperforming the market. So it's a slow bleed out of capital, unfortunately. It's my opinion. Would you rather buy Google or Amazon at these valuations? Probably, that's a great question because Google's at all-time highs. I own both of those and I'm not selling either, but probably I'd probably pick Amazon right here just because Google's stretched up so much. But yeah, I think Amazon's a winner in the long run. Amazon's so innovative. I do own them, so I might be biased. But let me go to also ULTY. This is another one. Like, it's not just QILD I'm picking on. It's kind of all the covered call ETFs. I mean, look at this one. This one started legit in 2024. March 2024, it was $20. Now it's $5, at an all-time low. And again, it says there's 135% dividend yield. It's actually not. It's lower because the future payouts are going down. And as you know, as the stock price goes down, it makes the yield look higher. So I avoid these. You buy them again to maximize that dividend income, but it hurts you in the long run. Okay, NVO, Novo Nordisk. So this is the company that owns Ozempic. If you've heard of, Elon Musk is on Ozempic. They also own Wegovy. So they own those two weight loss prescriptions, and that's most of the business. 93% of all their sales come from obesity care products, so it's a pure play weight loss company, and they've been growing very nicely. And this is they're a European company, but I've converted the currency to USD. They're making over $4 billion of after-tax net income a quarter. Can you believe the profits they're making? It's ridiculous. And also, you get a 3.3% dividend yield. One reason the stock has fallen from its peak is because they lose their exclusivity for Ozempic in about a couple years, like 2 to 3 years. So their Ozempic patent expires soon, which is unfortunate. And they see some increased competition from Zepbound with Eli Lilly and other GLP-1 makers. But I honestly think this one's probably oversold, probably a bit undervalued. They're trading at 14 times net income. That's very low for the industry and what they sell. Industry average is at 22, but I think it's that future uncertainty why they're trading at the below average multiple of the exclusivity. So there's that one probably properly valued right now. I don't know. What's this app? Oh, yeah. Hey, if you want to get this app, it's in the link tree in my bio. Very first link there. It's a brokerage where you buy stocks. It's my favorite one for analysis and stuff. Let's see. ICHR is a good long-term play. iCore Holdings. This one's on my watch list. I unfortunately see a bad stock price. So the stock is the same price that it was back in 2017. Sometimes I add stocks to my watch list if they're really bad, but not normally. Let's go see what they do. So they design, engineer, manufacturer of critical fluid delivery subsystems. Okay. Let's see. Are they profitable? So bad news. They're not making any net income. So they are losing a bit of money, but the sales are up 19% year over year. Let me see what's the market cap on this guy. So a $580 million company. So yeah, that is unfortunate. So they're worth $580 million. We really want to see them narrow these losses, because losing 10 million isn't great. We were hoping that trend would get better based off that trend. So, but the sales growth is good, up 18% year over year. So I can see why that one's not doing too well because of those net income losses. But I do like the sales growth. But yeah, they're so small. They really need to get to profitability soon. NVO has weight loss pill in the pipeline. Oh, hey, so does Eli Lilly. I think Eli Lilly just created that as well. Let's go over another healthcare play. So someone said, let me pull this up right here. You know who just bought a bunch of this stock is Warren Buffett. So if you go to the Warren Buffett portfolio, as we know, these are super investors that have to reveal all their holdings by SEC law. And his most recent purchase was actually, or one of the three, was UNH, United Health Group. he bought 5 million shares of UNH, which is pretty interesting. So let me go analyze them. And Warren Buffett, he always does his due diligence before he buys a stock. He wouldn't just buy some terrible company. And so that's why legit on the day the news dropped or the SEC filing dropped where he disclosed he had an exposure, the stock went from $270 to $300 plus. So that's pretty interesting. I wonder if there's any news down here. DOJ investigates UNAir's billing practices. Yeah, so there is some headwinds, regulatory headwinds. They're pretty much overbilling the federal government, like selling customers the back brace they didn't need. There's some allegations around that kind of stuff, but that being said, I wouldn't chase this one right here. I wouldn't buy it over $300. To be honest with you, I just wouldn't touch it over 300. The risk reward doesn't look too good. So yeah, that's why the multiple is so low. They're trading at 13 times net income, based off their historical average of 25. That's because the future uncertainty. We're a customer, by the way. We use OptumRx, and the OptumRx revenue just hit a record this quarter, up 19%. This growth is ridiculous. 133 billion of annual revenue for them. But yeah, we can see the net income's expected to drop off. It was $6 and Q4 24, and expected to go to $1.70, and that actually won't even cover the dividend. The dividend costs $2.20 a net income per share. They're only going to make $1.70. So that's one thing to be aware of to watch the margins. But yeah, that's why I wouldn't touch this one over 300. So if you can find it, maybe I just chill on that one. And I wouldn't make it as a meaningful size position. Like if I did buy them, I'd make them a small chunk of the portfolio. I mean, I wouldn't go all in on them. So yeah. Okay, what stock? Yeah, IREN. This stock right here has been a ridiculous performer. This is like the better version of CoreWeave, in my opinion. So they're a data center hosting. I believe they still mine Bitcoin. I don't remember, but this is what's so impressive about the stock. If you're wondering why they're at this new 52-week high level, why is the stock doing so well? It's because the financials are doing so well. They deserve it. Like, check this out. The sales went from 56 mil to 187 million, to a record. And out of this 187 million of revenue, 95 million of it was net income. Actually, I don't think it was. Yeah, okay, so only 16 million of it was net income, but still, they made ridiculous net income the past 3 quarters. I love that they're actually making net income. If you look at CoreWeave, they're burning through a couple $100 million a quarter. They also have a really good balance sheet. So IREN is actually one I really like. So super growthy. Sales are up 230% year over year. Pretty nice. I read a story about them. Like they were using their leftover Bitcoin mining equipment for data center hosting or something like that. Anyway. Rolls-Royce, what platform is this? So yeah, hey Victor, again, if you want to get this I'm on a brokerage right here where you buy stocks. It's in the link tree in my bio there, very first link. Or you can just type it into Google, it's just a brokerage called Moomoo. But if you go to link tree in my bio, the first link there, full disclosure, it is an affiliate link. So we'll both actually get a little fractional share of stock. Full disclosure. So anyway, let's look at Rolls-Royce. So a lot of people know Rolls-Royce as a car company, but they're really an aerospace and defense company. They make jet plane engines. They're pretty crazy. Look at this stock right here. It's almost unbelievable. Went from $1 to $15 just since 2023. So they've had some incredible stock price appreciation. And yeah, so check this out. Did you know half of Rolls-Royce revenue comes from aerospace, civil aerospace? Then it comes from defense, power systems. So they're really an aerospace and defense company. They're a European company, so they report like weird in halves, but they made the first half of this is a record net income, after-tax net income of $6 billion. So for the past 6 months, insane. So they're super profitable. Did they have a dividend? August 11th. Yeah, so they just started paying a dividend again. So they brought the dividend back. And even after all this, they're only trading at 16 times net income. So pretty interesting, Rolls-Royce there. So someone said, oh, Figma. So I wish I could give you more thoughts on this company because they did just IPO. Dang, yikes. They had an ugly little gap down there. Let me go analyze this company. This is like an app It's like a software development application. Like I know someone who made a phone app with them. So the sales are very nice. Check that out. Again, they just IPOs. So there's not that much history, but the sales are up 41% year over year. That's very good. And last quarter they were 46%. So very nice growth. And they made net income the past 2 quarters. So that's really good. Very good, very strong balance sheet as well. I'm actually going to add Figma to the watch list. They I got to do a forward multiple on them. They could be undervalued. I don't know. I think they're worth looking into. Could you show your whole portfolio? Yeah, by the way, if you want to see my entire portfolio, I share it on my YouTube channel. My YouTube channel is called Nathan Robert. I never hide anything. I like being fully transparent. Like I go to so many other TikTok streams. No one ever shares their entire portfolio. If you look in the top left, I'm up 15% all time in here. I like showing all my winners and my losers. I used to have a stock called ChargePoint. I lost $2,000 on it, but I sold out of it. So, and then I have my Robinhood account. We are up on every stock in here, luckily. This is my dividend growth portfolio. So every stock in here actually pays a dividend. But, growthy companies like Meta, Google, Constellation Energy. Okay, let's keep going here. RELY, please. All right, what is this one? So what Remitly, something like that. Okay, so $4 billion market cap. They haven't been doing too well since their IPO back in 2021. Let me see what their financials are doing. So the sales are very nice. Sales are up 34% to a record. Looks like it hits a record like every year, every quarter. And a net income is positive now. These year-over-year growth rates are very nice. Let me see if analysts are expecting them to continue. So yeah, they're expected to make net income from now on the next 2 quarters. And the revenue is expected to just keep on climbing up as well. Notice they always consistently beat on the analyst expectations on every metric. So RELY is actually pretty interesting. I wonder why the stock has been flat for so long. Maybe it's because they're just now finally making some net income. So, they're in the best position they've ever been in. Sales are going to continue to grow. Net income is too. Pretty good balance sheet. Okay. Was thinking of adding Cheesecake Factory, Nike. I would be careful with Nike, but I love Meta, Google. SCHD is a cool ETF. SPYD or SDY? What is SDY? The S&P 500 dividend ETF. So here is the S&P dividend ETF. What does it own? So Verizon, Realty Income, Chevron, Pepsi, Target, Kimberly-Clark. So a lot of the higher yielding names. So you get a 2.5% yield. I'd probably pick I don't know what SPYD is. This is another ETF right here. So let me go to its top holdings. It's CVS, Apache, Best Buy, HP. Honestly, I like this one more. I like SPYD more, just at a quick glance. Hey, what up, Victor? No problem. No problem. Let me know if you got a stock you want me to look at, Victor. I'll check it out for you. Olay said, IO&Q. So this company just got a big stake in from Amazon. I wonder if I can find some news about that. No. Okay, so Amazon bought, not much, $40 million of this stock. Again, they're a $12 billion company. To be honest with you, I just wouldn't buy this stock individually. I think they're just all momentum right now. If we look at the sales right here, $10 billion company, or what was it? $12 billion company, and the sales are 20 million. And, they've lost 177 million. That's over 10% of the entire company, 200 million. Or no, it's not. No, that's 1%. Sorry. They're $12 billion. That's crazy. But still, I don't like these net income losses. But one good news is the sales are growing. Sales are up 81%. If we look at the revenue expectations, it's expected to go to 26, 35. So I think they're just all momentum. I can't pay 12 bill market cap. I think I'd be super careful with that one. I'd like swing trade that one. I wouldn't just buy and hold that one for the long run. Can you analyze DFDV? What's this one? So DeFi development. So yeah, let's check it out. So a pretty small company. They're only worth $300 million. But let me see what they do. So the sales are only $2 million, but that's a record sales quarter. So $2 million of revenue. Says they made $15 million in net income. They didn't actually go to operating profit. They actually lost $4 million. The balance sheet just what happened there? So they diluted you by $63 million either through debt or share issuance, but they invested $61 million into a new asset, a new company. So that's actually good news. I do like that they just invested 61 million. So honestly, the future growth of the revenue, yeah, should continue to grow, whatever the $60 million investment was. But I'd be pretty careful with them. Again, they're still only worth 300 mil. Uh, just be careful with them. Celebrate. What's up, man? Yeah, I hope y'all are having a great Sunday, by the way. This is Euro Seas. Yeah. If y'all want to support me, best way is just hit the like button, hit the follow button. I sell nothing. I have no course book, nothing like that. So here's ESEA, another very small one. So they're worth $430 million, but the stock, they're at a new multi-year high today. So they're at a multi-year high. Are they a shipping company? So um, ocean going transportation services. Yep. So they're a shipping company. And look at that. All the revenue comes from Greece. So this might be an ADR. So you might have to pay some foreign taxes. But I know these shipping companies usually have nice yields. You get a 3% yield with this company. Whenever there's supply chain logistics issues, I know these shipping companies really benefit. Yeah, they're making a lot of net income. This is in USD, basically 30 to 40 million of net income every quarter. So pretty nice. Let's go see how much the dividend costs. So they made 29 mil of net income this quarter. Just for fun, let's see how much the dividend cost, and it only cost 4.5 million of net income a quarter. So nice. ALLR just got fast track FDA approved. Let's check it out. Okay, so we don't really cover these kind of stocks, so check it out in the top right. They're only worth 28 mil. That's super tiny. So a super small market cap of $28 million. Yeah, so they have no sales right now. Obviously, you just said they just got FDA approved, so I wouldn't expect them to have sales. That's why when we go to revenue, it says no data. So that explains why the stock rallied up, that they'll finally have some future sales. I like this, but without money to operate. Yo, what up, Samar? How's it going? What up, Kudo? He says DF. Oh wait, yeah. What's up, man? Um, Steven, what's up? He said NAMS, New Amsterdam Pharma. They're at an all-time high. Nice. So they're a $3 billion market cap stock. Let's see, discovery, development, and transformative. Okay, so they had a nice beat on revenue. That's actually ridiculous. That's why they're probably at all-time highs. Analysts were expecting 1.8 million of revenue, and they made 19 mil. Huge beat on so they were expected to lose 66 mil. They lost only 33 mil. Huge beat on the net income losses. This is great news. I'm actually going to add them to the watch list. This is a delightful surprise. So they're narrowing their net income losses because these losses aren't great. But they have a fortress balance sheet. So even if they continue to lose this kind of money, they can afford it because they have $739 million of cash and no debt on the books. So that gives them a lot of, freedom. It's a big safety net, just no debt, lots of cash, sales are growing. So pretty interesting. They remind me of like a CRMD. Pretty cool. Did I miss the Rocket Lab breakdown? Yeah, I did cover Rocket Lab, but if you give me a minute, I'll type it in the chat again and I'll check it out for you. So Nicholas said ARLP, Alliance Resources. Hey, this company's on my watch list. I forget why. Joshua, no way. He says I work for Comfort Systems. Great company. Yo, Joshua, that is so cool to hear. Hopefully you got some stock in the business because they're booming. The company, they're a serial acquirer. I'll talk about Comfort Systems after this. So here's Alliance Resources. So this is a $2.9 billion company, and they're trading at 12 times net income. Let me see here. So Illinois Basin Coal Operations. So, this is a coal play. So Appalachian Coal Operations and the Illinois Basin Coal Operations. So if you want exposure to coal, this could be a way to. Now, I think one reason the stock has been struggling recently is because they kind of lost the growth. Sales are down 7% and the net income's down 39. So that means they're losing their margins. Still decent margins, like double digit, but we don't love to see these declines. So we want to see that start to come back. But yeah, 12% dividend yield. Wow. So yeah, there's one a stock if you want exposure to coal. Okay, so yeah, someone said Joshua said I work for Comfort Systems, great company. I agree, man. This is a HVAC company, heating, ventilation, air conditioning. They also do the electrical work. They do plumbing. They service over 12,000 buildings. It's super boring. It sounds like a boring business, but they make really insane money. Like if you go to their mechanical segment, it's up 12% year over year. Their electrical segment is up 49% year over year. They acquire so many different companies because it's such a fragmented industry. HVACs, you'll just hire whoever's local to come repair your HVAC. You're not really like, there's no big company. It's such a fragmented industry, and they just acquire all the little mom and pop companies because less and less popular for them to hand down the business to someone. But anyway, the revenue's up 20% year over year. This is the best part about this stock. Revenue's up 20, but net income is up by 72. That means they're expanding their net margins to 43% net margin growth. The net income growth in the middle here is honestly the best part. No one expected, like the EPS beat insane. They're expecting $4.79. They did $6.50. Incredible beat on every metric. Comfort Systems deserves to be at all-time highs. They're actually my largest holding out of every stock by far, like 15% of my entire portfolio. So, hey, Jenny said, yeah, hey, try not to spam here. MAA Apartments for my homework, please. So, hey, this is ticker symbol MAA. I actually used to own this company. This is a apartment REIT, a real estate investment trust. That means 90% of their assets are real estate, and they own apartments in the Sun Belt area. And because they're a real estate investment trust, they have a 4% dividend. And that, for an average stock, this seems abnormally high. But because they're a REIT, they're taxed differently. They actually have to, by law, pay out 90% of their taxable income in the form of a dividend. So that's why they have that abnormally high dividend, and it's completely sustainable. So one thing for REITs, I will say, you don't look at net income. You actually look at the cash from operations because it's so important. Because net income right here doesn't include the depreciation and the amortization, which is super important for real estate assets. So you go to the cash from operations, they made $353 million in the most recent quarter, and let's go see how much the dividend cost. It only cost $178 million. So pretty cool. They have a very strong credit rating from S&P Global and Moody's. So yeah, that's an apartment REIT. Yo, Nathan, still holding Comfort Systems? Yes, sir. I haven't taken a single share of profit. I bought all my shares during this April dip right here. I was lucky enough to even buy a share right here. But yeah, I bought all my shares in April, and I haven't even taken a single trim of profit on them. I'm just gonna continue to let them win. What's this app right here? Yeah, hey Krim. By the way, I'm on a brokerage right here where you buy stocks. If you want to get it, it's in the link tree in my bio, the very first link there. Um, it's just it's my favorite one, lowest fee, and it is an affiliate link. Full disclosure. So if you go in and sign up and deposit, well, $100, we'll both actually get a fractional share of Nvidia stock. So full disclosure. But Nate, how's your Coca-Cola? So yeah, by the way, this is Coca-Cola Consolidated. They had a great past couple of weeks here. They were almost out this like little. They're almost going to fill this gap up here. But Coca-Cola Consolidated, this is the bottling company for Coca-Cola. So they have a much lower dividend yield, a 0.6% dividend yield. But look at that payout ratio, only a 5% payout ratio. They're trading at 17 times net income. They just bottle all the products for Coca-Cola. They bought the affiliate rights for $1 like 100 years ago, and they can just bottle and sell their products wherever. And the largest shareholder is Coca-Cola. So if you do own the normal KO stock, 21%, they own 21% of this company. Okay. Hey, what about Nvidia? I have not looked at Nvidia today, so let's do it. So Nvidia, world's largest company. Here's one thing I will say: if you just buy shares of this stock, no, they're only worth they're worth $4 trillion. So if you buy the stock right now, for you to double your money, they have to go to an $8 trillion market cap. So they're kind of falling right now in the law of large numbers. It's hard for them to really double that market cap. But here's why NVIDIA is a great company. They deserve to be where they're at today. They have a huge GPU market share, obviously, 20% PC GPU market share. They have this little automotive revenue, very small, only 500 mil a quarter. But, Lucid uses it for their autonomous driving cars. Lucid might go bankrupt soon, unfortunately. But also, the main growth driver for NVIDIA has been the data center business because data centers need GPUs. NVIDIA makes their own GPUs and they can get them the cheapest and the quickest. So that's genius for them to get into data centers. They're so growthy. I mean, what other company is growing like this? Sales are up 55% and the margins are ridiculous. So out of this 46 billion of revenue, 26 billion of it was after-tax net income for them. They legit have 50% net margins. They print money. They have ridiculous free cash flow numbers too. Fortress balance sheet. Like NVIDIA is just a behemoth. So they also have a nice share buyback program. But yeah, 26 billion net income just this quarter. That's ridiculous. So John said thoughts on Roblox and then Joby. We could look at Joby and Hive. Yeah, we'll look at Hive too. So let's look at, Roblox right here. That's actually a stock owned by Kathy Wood, if anyone knows who that is. And her second largest holding, 6% of her portfolio is in Roblox stock. And this one has had some crazy stock price appreciation recently. But honestly, I would avoid this one at this price. Honestly, I would avoid it over $100 low key. I wouldn't buy meaningful amounts over $100. But here's why they have been doing so well, and they probably, they might deserve to be up here. But look at this is their most important metric, their daily active users. Their daily active users, the most recent quarter, was 111.8 million. So it's 111.8 million. In the same time last year, it was 79 million. That is a really nice increase in their daily active users, the most important users. But here's the bad news. They are losing a lot of money because they're stock-based comp. They're losing a couple $100 million of net income every single quarter. So, and they have a bit of a leverage balance sheet. But I don't like these huge net income losses. The sales are growing nicely. Sales are up 20%. But the huge net income losses scare me. But those daily active users are very impressive. But I think they're overvalued at this price. Okay, so Joby Aviation, then we can look at Hive. So Joby, let me redo my analysis on this company. So if you look in the top right, they're worth $11 billion. So the whole entire company is worth $11 billion. And here's the unfortunate part. One thing you do got to be aware of. This is still basically a startup. Like the revenue was $15,000 in the most recent quarter. So do beware, $11 billion company, $15,000 of sales in the past 3 months. And they lost 300 mil of net income this quarter. 100 mil last quarter, 250 mil. So they're burning through net income. Luckily, they have a really good balance sheet. And I think they're backed by they're backed by Toyota Motor. So Toyota Motor owns 15% of all the shares. So I'd be careful. Are they expecting sales soon? So no, not really in the next 2 quarters. So analysts are expecting them to not have sales for the next 2 quarters. So it's not like them having no sales. That's already priced in the stock. So, but I think it's tough paying for that valuation. So let's look at Home Depot. Yeah, we can look at them too. So Hive Technologies, unfortunately, I believe this is just a Bitcoin mining. Drillion. For the stop loss, I would just look that up and you can find it on the Moomoo support. I don't want to explain that right now live, but I do appreciate you. But here's Hive right here. This is a Bitcoin mining company. And unfortunately, these Bitcoin mining stocks just don't outperform actual Bitcoin. Like this stock is pretty close to all-time lows. The sales are expected to, monster rally up 45, 77, 103. So the next 2 quarters should be pretty interesting for the stock, actually. Do beware. But yeah, you really just look at this company's net asset value of all their crypto assets. So I'd be careful with that one. So here's a stock that's been doing very well recently on the high probability of an interest rate cut this month. So in September, there is a 90% chance in the next 30 days of interest rates being cut. So, this is a, interest rate sensitive stock with the housing market. So Home Depot right here, let's see how they're doing. Yeah, they print money, bro. They're making 4 to 5 billion, 4.5 billion this quarter. So like 3 to 2.5 billion of after-tax net income a quarter, and it should continue to grow in the lower interest rate environment. And you get a 2% yield, a very nice 2% dividend yield with this company. They trade at 28 times net income. That's not ridiculously expensive, especially with the net income projected to grow. So the actual forward PE is what you really want to look at. So Home Depot, I like that one. That's a great dividend growth stock to just buy and never sell, in my opinion. Um, oh, JVM, what's up? He said MO. Here's another higher yielding play. If you like high yielding dividend stocks, out of all the high yielding stocks out there, like out of all the companies that yield 6%, this is one of my more favorite ones because this is a company, in my opinion, that does have a very sustainable 6% dividend. Well, you can see that from the payout ratio. They have a 61% payout ratio, 6% dividend yield. So here's what's pretty cool about this stock. Do beware, though, they are still down, from their they're lower than they were in 2017, but they have a sustainable 6% dividend yield. And here's what they sell. You probably can't really cover it on TikTok, but they had a one-time adjustment last quarter. They actually made $2 billion of net income last quarter. There was some one-time adjustment, but well, let's just say they make $2 billion of net income a quarter. Let's not give them the benefit of the doubt. Even if you average out these 4 quarters, they're making significantly more than $2 billion a quarter. But let's just say they make $2 billion of net income a quarter. Well, the dividend only cost it cost $1.72 billion of net income a quarter. So they can easily afford the dividend. And since they have so much leftover money, they're spending a couple $100 million every quarter buying back their own stock. Since they have leftover cash, why not? So Mo's pretty cool. Okay. So how about Lululemon? Let's check them out really quick because this one's been pretty popular because they just reported earnings. They fell 19% on Friday. The thing was, there was some good and bad news. Bad news is Lululemon, their main market, North America, sales were only up 1% year over year. That doesn't even beat inflation. So the North America sales were only up 1% year over year, but the international sales were up by 25% year over year. So when we average those two together, the total sales were up 6.5%. And also the sales were up by 6, but the net income, the profits fell by 5. So unfortunately, the margins did fall, 11% year over year. But it's not the end of the world. They're still making a bunch of net income every quarter. And what are they doing with all that net income? Well, Lululemon's plowing it all into share buybacks. Unfortunately, all these buybacks have been poorly timed because the stock fell 19% on Friday. So if they didn't buy back any shares, or if they waited, they could have bought back 19% more shares with that money than they could have before today, or actually significantly more than 19%, depending on where. So Lululemon's tough. I think they're probably going to go back down to that 10 times net income multiple because they just sell a commodity. But they're worth looking into probably around 150. I think I don't know. That one's tough because there's I can hear both sides of the story there. Do you like Walmart, Dollar Tree, Target? Out of all those, my favorite pick is Walmart. Walmart has that McDonald's franchise system where a couple percent, I forget exactly, but a couple percent of every um, sales, Walmart sales stores go back to this company as a royalty, basically. Let me see if there's any news here. Walmart Plus expands streaming operations with Peacock Edition. AI super agents. Okay, whatever. Walmart is also, I like Sam's Club. Sam's Club is like a mini Costco. You have to have what's it called? You have to have a subscription just to get into the store, whether you go there or not. They're making that revenue every month of the subscription. And when you go to Sam's Club, you're buying stuff in bulk. So, you get a good deal. And check out the net income. I mean, Walmart prints money. I mean, was that a one-time adjustment? Yeah. So they're pretty much making $5 billion plus of net after-tax net income every quarter. Get a 0.8% dividend. They're recession resilient. In 2008, just like with McDonald's as well, the stocks didn't fall in 2008. Okay. My friends don't like them anymore. Better legging brands out there and cheaper. Yeah, there's like this Amazon brand that's like really good. I forget. I don't know. But yeah, AbbVie has a decent dividend. I love AbbVie. This company has a very sustainable dividend. Or there, in my opinion, no chance of this dividend being cut. the dividend payout ratio is actually not this, but they have a 3% dividend. They own some fantastic assets. If you're looking for a healthcare company, this one, in my opinion, for the rest of time, just should return 7 to 8% a year. They own Sky Rizzy, and the growth of this has been absolutely bonkers. I mean, in 2019, it was 350 million. Now it's 11.7 billion. Just in the most recent quarter, it was 4.4 bill, up 62% after growing 44, after growing 50, after growing 85, after growing 104. So the growth has just been ridiculous, and that's just their main sale. That's just their main prescription. They have Rinvoq, whatever this one is. It's up 41 after going 45, after up 55, after up 55, after like the growth is just nuts on AbbVie. So that one is a great never sell one. Just like Eli Lilly. Eli Lilly, AbbVie, these are great ones. So Adam said SoFi stock. So let's do it. I do own SoFi, by the way. Let me show you my position. I might be biased, but I regret every share I've ever sold of SoFi, man. But I do still own 24 shares left of this company, man. I bought SoFi way, way, way back here, like nearly 3 years ago. And I haven't really just touched my position since. They're a fintech. They have their own banking charter. They got it through a loophole that's now patched because of them. Check this out. This is why they deserve to be at $25 plus. This is why they deserve this huge 3x increase. Their financial services business has grown at a rate that just beat every expectation. My expectations, even the analyst expectations. I mean, the financial services revenue is up 105%. It's 363 million of revenue. It just hits a record every quarter. If you look at this on an annual basis, I mean, in 2020, it was 11 million. For that entire year, it was 11 million. Now it's 820 million. I mean, it's such good growth. Also, the lending revenue is up 30% year over year to a new record. People are just really taking them serious. They made 100 million of after-tax net income this quarter. The revenue is up 43% after growing 20. I mean, just super good growth. So I love SoFi. I might be biased though. What up, Steven? He says I'm up 11% on Google. Yo, congrats if you own Google. They're great. They're great. What's your opinion on ETFs? Are they worth investing into? Yeah, I love ETFs. This right, like every person basically retirement is basically an index fund, and an ETF is just an exchange traded fund. So you're basically this right here is the S&P 500 index fund, just on an exchange. So you just buy ticker symbol VOO. You're legit just buying the top S&P 500 companies, Fortune 500 companies by market cap. So it gets you exposure to NVIDIA, Microsoft, Apple, Amazon, Meta, Broadcom, Google, Berkshire Hathaway, all these companies that are happily owned individually, all the best companies. So yeah, VOO, also QQQM. This is the better way to get exposure to the QQQ, lower expense ratio, same NASDAQ 100 strategy. They just don't market this one. They market the QQQ. They don't market the QQQM because they don't want to make as much money. Does Moomoo give you annual growth forecast? I think so, Georgia. It gives you the next 2 quarters. 500 shares of SoFi. Hey, RG, you must be doing great on your position. Someone said, what do you think of SHLD? This is another ETF right here. This has been a very popular industry. Like, I like ETFs because you can pick sector specific ones. Like if you want exposure, like let's say I want exposure to the global and defense industry, but I don't know which stock to pick individually because I've looked at Palantir, I've looked at Raytheon, Lockheed Martin. I don't know which one to buy individually. Northrop Grumman's a great one. Instead of trying to pick and choose, just buy the whole industry. It breaks your money up for you, diversifies it. Why not do the smarter thing and be more diversified? You still get exposure to the industry and better or safer returns. So anyway, this is an ETF that gives you exposure to the main global or the global defense stocks. Okay, so someone said UPS right here. So this is a company that I think has an unsustainable dividend. So here's the thing. When we look at this company's yield, they have a 7.7% yield. Most people look at that and they're like, wow, that's good. You're supposed to get 7 to 8% returns from the S&P 500 a year. You get it just in a cash dividend every year. But here's why I think it's unsustainable. Also, their average daily parcel volume fell by 4 or 5% year over year. Not great. Here's the thing. They made 1.3 billion in net income a quarter. Like I saw, I was like, but they're making billions a year. Yeah, but look at this. They made 1.28 billion of net income this quarter, okay? They made 1.28 billion of after-tax net income, but the dividend cost 1.35 billion. So they didn't retain any of that money. Legit, they couldn't afford the dividend. Over 100% of their net income got paid out to the net income. So they had no leftover cash to, reinvest in the business, do share buybacks, do anything. They can't invest in the future without having to dilute you or issue debt. So, and the sales are down 3% year over year. So I'd stay away from UPS just because they couldn't afford the dividend the past 2 quarters. I think they need a healthy dividend cut because they're actually making good money, but it's just all eaten up to the dividend. They have no leftover cash. Hey, what's the ticker symbol for Sentinel One? Do you own any healthcare stocks? I do, but they're very risky. So I wouldn't recommend these unless you keep it as a very small position. I own CRMD and DCTH, and I own those two. And my other healthcare name is one I'm down on is CPRX, Catalyst Pharmaceuticals. That's my other one. So yeah, those are my three healthcare names. They're all very small positions because they're all so risky. So I keep seeing people ask about Open Door Technologies. Yeah, so let's check this company out. This company, if you're wondering, if you've never heard of them, what they do is they just flip houses. And to be honest with you, they're not great at flipping houses. But one thing that investors are so happy about, there's so much momentum in this name right now. I wouldn't touch it, especially over $5. But the hope of a lower interest rate environment, because check out what happened in 2022 with zero interest rate environment. They were making dollar hollers, 4 to 5 billion of revenue a quarter. But check out they're super interest rate sensitive, and check out what happened as rates hiked up. These year-over-year declines down here don't look good. Sales fell 70%, 69% to under $1 billion. So high interest rates really hurt them. But we now have with 90% certainty, interest rates are going to get cut this month. So they're rallying off that. They also fired a bunch of staff, and it's really helping out their bottom line. They're narrowing their net income losses, which is good. They're still losing money every quarter, but at least they're narrowing the losses. So this one's just seen a lot of momentum. Looks like analysts are, oh wow, 540 mil of revenue in 2 quarters. That's going to be an all-time low revenue. If that's right, maybe that's wrong, hopefully. But anyway, I'd be so careful with that one. It's all momentum, I think. So, oh, uh, ticker symbol S. Okay, let's do it. So, did you sell your Amazon? No, I have not sold any of my Amazon ever. I keep buying more shares. I'll show you after this. Oh, what up, Pinky? Hey, good to see you. We can look at Eli Lilly too. Yo, hope y'all are having a great Sunday, by the way. If you want to hit the follow button, we stream every day, every Sunday, this exact same time. And also, I forgot to say this at all. We're going to be streaming in exactly 7 hours from now as well when the market's open. Normally, I stream when the market's open, but so if you want to hit the follow button, we'll be streaming in exactly 7 hours from now as well when the market's open. So here's Sentinel One. And by the way, I sell nothing. I have no course, book. I sell nothing. I'll never follow you, DM you. Watch out for people impersonating me. So this is a fintech right here. So if we go to the sales have been growing very nicely. Sales are up 22 after growing 33. So I like companies that are growing their sales, but one reason I think the stock has been struggling is because they're still losing a lot of money. Check out last quarter. I mean, they lost 72 mil. 200 mil, 80 mil. So for the longest time, they've just been burning through money. So I think investors just want to see this company trend toward net income positivity. Doesn't look like the trend is getting better. I do like the sales growth, but they have actually a pretty good balance sheet as well. So, but I do want to see those net income losses start to narrow. Sentinel One, I feel like I've heard of them before. That's Capital One. I've never heard of Sentinel One, I don't think. Okay. Stock. Oh, that's Realty Income. That's a REIT. That's a triple net lease REIT. Oh, BMY. So this is Bristol Myers Squibb. This is a health insurance company, I believe, some sort of insurance company. And yeah, so look at that. Bristol Myers is the exact same stock price that it was back in 1998. So they have been flat for a very long time. Do they have a nice yield though? Yeah, so that's probably why. You get a 5% plus dividend yield with this company. So actually, this is not an insurance company. So they looks like they sell a bunch of different prescriptions, I'm guessing, like Eliquis, that's up 7. Uh, Opdivo up 7. This one's up 1. That one's down 40. So honestly, when we average all these prescriptions together, the sales were only up by 0.5% year over year. So honestly, I would like to see some more growth in that. That doesn't really beat inflation. So sales are up by 0.5, and the net income actually fell by 22. Or actually, it was actually up. So they had a little one-time adjustment, but still good news. They're making a couple billion, like, oh wow, I remember that loss, but they're making a couple billion a year, which is nice. Let's go see how much the dividend costs. You know what, for fun. So if you average it out, they're making just say a billion plus of net income a quarter. The dividend cost 1.26 billion. So they at very least need to make 1.26 billion of net income a quarter, and they have been doing that for the most part. So they're nothing. I'd be careful though. I probably wouldn't buy that. Walmart and McDonald's, those are two great additions to any portfolio, Malik. I completely agree. Walmart and McDonald's are, if we go into a recession, tech starts crashing. In those environments is when like these do good. Like in 2008, when everything dipped. Look at McDonald's; they didn't dip at all. They were flat. That's because McDonald's is really a real estate. It's really a real estate in a royalty company. If you go spend $100 at any McDonald's, $4 of it goes back to this parent company as a royalty. Also, they own the land under 80% of all the stores. So even in a recession, the franchises take on all the risk. That's what's crazy. That's how McDonald's has near 40% net margins. There's no restaurant that exists out there that has 40% net margins. That's because this isn't or 30% net margin. That's because this isn't a restaurant. They're a real estate royalty company. Even in a recession, when the franchises are struggling, McDonald's still receives the rent every month from them. Okay. So, and also in a recession, McDonald's sales historically go up. People stop going from Starbucks and Chick-fil-A, they go to McDonald's, and they acquire a bunch of cheap land in a recession. So they're almost, in my opinion, Walmart has the same model. They're recession-proof almost. Walmart has the same model. You go spend $100 at any Walmart, a certain percent of that goes back to the parent company. Walmart has the best real estate portfolio of like any company out there. Like the most valuable real estate Walmart owns. It's ridiculous. Like in terms of like closest to logistic hubs. Like, okay. All right, let's keep going. Some more stocks. BYRN looks good. Let's check it out. So I don't own this one, but they're on my watch list. So this is a very small one. So a $445 million company. So do beware with these smaller market caps. They're tough buying, but here's the good news. They're actually net income positive. Out of all the 400 mil companies out there, I want one that is net income positive, making net income every quarter, one that is super growthy, one that has the sales up 40% year over year after growing 76. Sales are growing nicely, net income positive, really good balance sheet. So that's why they're on my watch list. Looks like analysts are expecting in 2 quarters as well, the sales to spike up to 34 mil. And them to stay net income positive. That's great news. That's great news. Okay. Yeah, Walmart and McDonald's are really good, but do beware. These won't really outperform the market in the long run. Like McDonald's will probably return 6 to 7% a year. When probably the S&P will probably return 8 to 9% a year. So but they're good to have in a diversified portfolio. Like I own a lot of I own everything. I own some of the recession safe stocks, recession resilient stocks like McDonald's, and I also own some of the super growthy names that do good, like Meta, Google, United Rentals. Some of these names, Amazon. Oh yeah, someone asked about Amazon earlier. Yeah, I do own Amazon. I just recently bought my whole entire position in this company. I really like Amazon. If the Fed drops rates, O will do better. You're right. So let me cover O real quick. This is actually one of the few stocks that pay monthly. So if you're a dividend investor, this one's pretty cool because you get paid 26 cents every month with this stock right here. Ticker symbol O, Realty Income. But do beware, these don't outperform in the long run. Like this stock is still below where it was in 2019. You know, in 2019 it was 66. Now it's 59. But what you do get is a sustainable 5.5% dividend yield that pays monthly. This is a REIT, a triple net lease REIT. Their main customers are like 7-Eleven, Walgreens, dollar stores, Lifetime Fitness. But yeah, they're pretty cool. Try to basically maximize the dividend income. All right. So, ooh, could you do MANU? MANU. What is this one? Manchester United. Oh, this is that I think a football company or something like that. Yo, wonder if, so this is a $2.7 billion company. I've looked at this one before with football season coming. I think this one might so we do got to convert the currency. They're not a US company, they're UK obviously, but operation of professional football clubs. Wow, they're doing a lot of revenue, 200 mil a quarter. Yeah, all the revenue comes from the UK. So this is exposure to football, I guess. But the thing is with this company, they've never really made any money. Like for as long as we go back, I mean, they're not making any consistent net income. So that's the bad news with this company. Uh, but I wonder if I don't know. I wouldn't buy that one to be honest with you, just because of the inconsistent net income there. Realty Income and Main Street Capital. Yeah, another. I actually own this one, by the way. If I head over to my Roth IRA, I do own Main Street Capital, which is another monthly paying dividend stock. So I get a dividend every month from them, which is pretty cool. So yeah. Thoughts on Snowflake? Oh yeah, Snowflake. This is like your Palantir competitor. Uh, Let me see if there's any news I can see about this company. So Robinhood appoints as new CFO. Simmons and Snowflake do a partnership. Yo, Simmons, they're a really cool electrical infrastructure company. But anyway, let's look at Snowflake right here. There's some good news and bad news. Here's the good news. They are extremely growthy. Check out the annual sales. I mean, it just hits a new record every year. So that's what you want to see in a growth stock. And they're continuing that growth. It's 996 million. They're nearly at their first ever $1 billion revenue quarter. So revenue's up 31, but here's the bad news. They're still burning through a lot of net income. They're losing a couple hundred mil a quarter, but this quarter specifically, they lost less net income than expected. So that's good news. Losing less net income than what the analysts expected because they have so much stock-based comp. You know, if you go to the free cash flow, it's positive, but the net income's negative because those non-cash expenses, that stock-based comp, is included in GAAP net income. So we do want to see those net income losses narrow, but Snowflake, great news, great quarter they had. Ooh. What price would you buy more CEG at? Okay, and also look at DTE. Yeah, DTE stock. I would buy CEG under like 280. Uh, I love CEG. But here's DTE Energy. So let's check out this stock. It looks like a utility stock, I would have to guess. And yeah, these utility companies have very safe, very sustainable yields. You get a 3% dividend with this company. Very nice. And they trade at 19 times net income. You know, that's in line with the industry average for utilities. Yeah, so electric energy trading. That's interesting. Gas, DT, DTE Vantage. All right, let me just look at the net income here, though. So yeah, very consistent net income. 3 to 500 mil of net income every quarter. Sales were up 19. That's actually pretty good for a utility, so not too shabby. Ooh. What about APLD, KO, PEP? Um, Let's look at Coca-Cola actually. So that's actually a stock owned by Buffett. So Buffett approved message right here because 9% of his portfolio is in Coca-Cola. This company has a very nice dividend as well. So check this out. You get a 2.93, or we'll just call it, you get a 3% dividend yield with Coca-Cola. They trade at a 24 times net income. And yeah, look at these consistent profits. I mean, they're making 2 to 4 billion of net income every quarter, and then they just share it with you via dividends. I don't. With that being said, I don't expect Coca-Cola to outperform, the tech-heavy S&P 500, but it's a nice, safe stock to like diversify in if you want some higher income. I wouldn't call you crazy for that. I actually own the bottling company for Coca-Cola. This is COKE, Coca-Cola Consolidated, and they're actually the largest shareholder. Coca-Cola KO is the largest shareholder. Okay. Coke has destroyed ecosystems, draining water supplies. That's not good. TWO, very high dividends. Oh, is that Two Harbors? Hopefully, yeah. So I wouldn't touch this one. This is a mortgage REIT, and they pretty much they pay out more money than they make, and the stock slowly collapses. So check this out. If we look at this right here, they have a 16% dividend yield. And most people are like, hey, 16% dividend yield, let's go. That's pretty good. But here's the thing. They can't really afford it. Like if we go to the net income, like they lost 200 mil, lost 80 mil, then they made 200 mil, but then they lost 200 mil. Like it just, if we look at the total, here's the thing. I just don't understand how to like look at these companies. If we go to revenue, just sales, the sales were negative 15 million. So it just looks so choppy to me. So I would be very careful with this one. If I wanted a higher yielding dividend stock, I would honestly, in all honesty, I'd rather go with the covered call ETF like a JEPQ over that one. So if you're looking for something with the higher yield, or for a high yield, I would go with this one. You get a 10.9% yield paid monthly. I would much rather trust JEPQ than TWO. So we can look at APLD too. Oh, Lamb, is that Lamb Research? We can look at that one too. How about Ethereum? Oh, we don't really look at Ethereum. Ethereum's kind of cool because you can stake it. Actually, let me see if I go right here. Yeah, like if you look right here, you can stake your Ethereum like at a near 2.5% APY. I don't own any crypto though. We'll look at CODA after this. Yeah, hey, what up, Celery? Good to see you. Hope y'all are having a great Sunday, by the way. What's this app? Oh, yeah, hey, if you want to get this app, it's a brokerage that I'm on where you buy stocks. It's in the link tree in my bio, very first link there. It's my most favorite one. And you can see all the like super investors portfolio, like Nancy Pelosi. And the new feature, you can like batch trade, follow them in if you wanted to follow their portfolio. But here's the NVIDIA portfolio right here. As we know, NVIDIA owns some individual stocks, and one of the stocks NVIDIA owns is APLD. So, again, just because NVIDIA owns a stock doesn't mean you should. So you should go do your own research on it. And I do like this one. This is a data center, data hosting, or a cloud hosting business. And one of the benefits of being owned by NVIDIA, being in the NVIDIA ecosystem, was they got a huge deal with CoreWeave. CoreWeave is also, of course, owned a bunch by NVIDIA. But yeah, APLD seems like a cool, actually, it used to break down where the revenue came from. Yeah, so they're in data, here's what they do. They're in data center hosting and cloud service business. So pretty interesting. They are owned by NVIDIA too. Yeah, what's the website? Yeah, hey, it's in the link. If you want to get this, it's where you buy stocks. If you want to get this app I'm on, it's in the link tree in my bio, very first link there. It's my favorite one, lowest fee brokerage. I keep my idle cash in here too because gives you the nice little daily interest, 4% APY. Yeah. It's by the way, it's an affiliate link. Full disclosure: if you go to link tree in my bio, first link there, we'll both actually get a fractional share of NVIDIA if you sign up. Or you can just go into Google. You can just type it in, just a brokerage called Moomoo. But yeah, let's go. CODA stock. Let's see. This is Coda Octopus Group. That's interesting. So we don't really cover these kind of stocks. It's a very small market cap. They're worth $89 million. So do beware. They do have a pretty tiny market cap. And the stock's been flat for a while. But let me go analyze them from their financials. So marine technology, marine engineering, acoustic sensors. How are the sales growing? Let's see. So the revenue is up 31%, but that's not much revenue. Only 7 million So do beware of that. But wow, this is insane. They're actually making net income on that. They're making nearly, a million of net income every single quarter. They have a monster balance sheet. Man, let's see. No debt on the books and 25 mil of cash. I'll actually add them to the watch list. Are there analysts covering this one? There are. They had a huge beat on revenue this quarter. So hey, actually, that might be worth looking into. 89 mil company, sales are up 39%, no debt, 25 mil of cash. So yeah, 25 mil of cash. So legit 30-40% of the entire company is their cash on hand. That's really interesting. So LRCX, LRCX. This is Lam Research. This is another semiconductor play, and I actually really like this one right here. Nathan, is RR still a bad? I just avoid Rich Tech Robotics. If you want exposure to a robotics, like a great robotics company, I wouldn't pick RR to buy and hold forever. I pick a different one like Symbiotic or Amazon. But here's Lam Research. I like this one because you get a near 1% dividend. So you get a pretty decent yield, and they're trading at 24 times net income. So, that's pretty fair for this industry. So 25 times net income, yeah. They manufacture and service of wafer processing semiconductor equipment. And check out the growth. The growth is finally back. 24 PE company that grows, that the revenue grew 30% year over year after growing 20%. The net income is up 68% year over year. So look at that. Sales are up 33, net income's up 68. What does that mean in English? It means they're expanding their net margins. That's a record net margin, 33%. That's very good, the margin expansion there. So the net income was 1.7 bill. So I really like Lam Research as a buy and hold for the long run stock. Should I sell my Lucid stock? Yo, I think so. Unfortunately, this company, if you're ever looking at a stock that's like at an all-time low like this, you're like, hey, it's at an all-time low. Maybe now's a good time to buy the dip on them. It'll maybe RSI bounce up. It looks oversold. But here's why I think this company is going to continue to hit new all-time lows. And yo, Banana Bun, thanks so much for the roast there, for the pepper. I appreciate that. If you got a stock you want to look at, let me know, Banana. But check this out right here. Here's the thing about Lucid. Actually, let me show you the market cap first. Remember, this is a $5.6 billion company. So the whole company's worth $5.6 billion, and you're buying a company that lost $550 million in net income this quarter. That's 10% of the entire market cap. In the previous quarter, they lost 400 mil, and then 400 mil, and then a billion. And they've just been doing this for years. Like if we zoom out, how long can they keep up burning a 2 billion plus of net income a year? And they've leveraged up their balance sheet. They've diluted you while the stock is at all-time lows. They've gone through reverse splits. So I wouldn't touch that one. Unfortunately, I feel bad if you own that one, to be honest. I never want to see anyone lose money or anything. Hey, what up, Seed? How's it going? And Sergio said, hey, would I go Vici or Realty Income? That's a good question. I actually honestly like Vici Properties more. So dude, you've probably heard of a lot of the companies. If anyone's in Vegas, probably heard of a lot of these properties that they own. They own Caesar's Palace in Vegas. They own MGM Resorts. What's that Black Pyramid called? Is it the Luxor? They legit own all the good. They own the Las Vegas Sphere. If anyone's heard of the Las Vegas Sphere, they own the land under it, so they get paid every month. This is a triple net lease REIT. Triple net lease REIT. They have a 5.2% dividend yield, and it's very sustainable. You can see the payout ratio right there. So I actually very much like this company. They made 880 mil of net income this quarter. 630 mil of cash flow. Well, let's go for fun. Let's see how much the dividend costs. The dividend cost, here's how you do that. You go to the cash flow statement, scroll down to the cash from financing activities, and then you can see right here, cash dividends paid. So they can easily cover this every quarter. They at least need to make 456 million a quarter. They're easily doing that. So that one has a sustainable 5% plus yield, not financial advice. So yeah. NVIDIA's not been doing so well. Yeah, a lot of like AMD as well. Some of the semiconductor names have been doing good. Like you look at Broadcom, they had an all-time high on Friday. All right, so what are these ones? So What platform is this? Yeah, hey, by the way, it's in the link tree in my bio. It's the very first link there. It's a brokerage where you buy stocks on. My favorite one, Linktree and bio, first link there. It is an affiliate link, full disclosure. We'll both get a little fractional share of NVIDIA if you sign up with my affiliate link and deposit. But someone said Pinterest. Yo, that's on my debt-free watch list. Actually, here, if anyone's curious, this is a watch list right here of every stock. And yo, Swifty, thanks so much for the rose there. I really appreciate that. So this is my portfolio where every stock in here has no debt. So Zoom, Reddit, Yelp, Duolingo, Pinterest. Yo, I wanted to cover Pinterest. That's the stock I was looking for. So Pinterest has no debt at all. Actually, if we go to the balance sheet, I'll just show you for yourself. Yeah, look at this absolute fortress of a balance sheet. So one cool thing about the stock is they have $2.6 billion of cash, no debt at all. So that gives them a lot of freedom, no debt whatsoever. And check this out. Here's a really cool metric we get. They have 578 million monthly active users. Versus the same time last year, they had 522 million. So it went from 522 to 578. Apparently, a lot of people are using Pinterest. So yeah, sales are up 17%. They're really just now getting to net income positivity. Like they lost money this quarter, last quarter. They make all their revenue on Q4 of every year. If you average it out, they are technically making net income every quarter when you average out this one quarter right here, like 40, 50 mil a quarter. So anyway, Pinterest isn't too bad with with the no debt. Yelp's kind of in a similar kind of, the stock's been flat since IPO, just like Pinterest. But yeah, great option. Okay, someone, is this say, yeah, hey, this is this app, this app that I'm on, this brokerage I'm on is safe, even if the company goes BK, you're still FDIC insured. And also this app that I'm on, this brokerage I'm on is publicly traded. Here's Moomoo. Here's their stock right here. It's ticker symbol FUTU. How many users they got? They got 27 million number of users. And it's nice to at least see that this company is making a boatload of money. They made 300 million of, after-tax net income this quarter. So by the way, I do own this stock too. It's been one of my better performers. So this app that I'm on right here, this brokerage, I love the brokerage industry. Like this brokerage I'm on, I own Robinhood stock as well. I own SoFi Technologies. Let me show you that real quick for anyone that's curious. Yeah, that's actually my best total in terms of total dollars, my best performing stock, FUTU stock. So yeah, that is my favorite brokerage. Again, if you want to get this app that I'm on, then it's my favorite one. Linktree and bio, first link there. So let's see. Thoughts on Unity or SoFi? What up, Dark? How's it going? Hope you're having a great day. So let's look at Unity right here. So wow, they had a great Friday. The stock is up 9%. So yeah, they've had a nice rally the past couple months here. They really don't have any competition, really. It's really just them and AppLovin, I believe, but there's not much competition. Here's one thing I would be aware of, though. The sales did fall 2% year over year. Did they just report earnings, though? So, okay. Analysts were actually expecting much worse. So the sales fell by 1.85. It looks like analysts were expecting much less than that. So they actually had a nice beat on revenue. Check that out. Orange lines, what the analysts were expecting. Beat on revenue, beat on net income losses, and they beat on EBITDA. So it was a triple beat quarter. That might be why the stock's doing so well. Still be careful, though. They are losing. Yeah, so the sales fell by 2%. So they're not growing sales, and they are losing net income every quarter. But the net income losses are narrowing at a nice rate, 15% better than the previous year. But I want to see the growth come back to the sales and the net income. So anyway, Unity, they are interesting. I wouldn't buy them at this price, to be honest with you. Hey, someone said Kava is my favorite restaurant. Wolf Speed. Hey, let me look at Wolf too. Sorry if I don't get to all the stocks, by the way. I really do try and get to all of them. And by the way, best way to support me, I sell nothing. I have no course, book, Discord, WhatsApp, Telegram, none of that. Only thing I do have is a YouTube channel. I'm really trying to build up the YouTube channel. So by the way, I do read the stocks in the YouTube chat first. So if you're desperate, you want me to see a stock, if you put in the YouTube chat, I'll almost definitely see it. I will cover it. That's my promise. But yeah, my YouTube channel is called Nathan Robert. It's also in the link tree in my bio. I'm trying to build up my viewers on there. Anyway, so I'm also streaming on there. If you missed anything, you can replay it after it's over. And sometimes I talk too fast. But anyway, here's Kava Group. This is like a Chipotle competitor, like a healthy restaurant. You're right. And they've actually been growing very nicely. So the sales are up 20% year over year after growing 52%. So the sales are growing pretty nicely. And they're making net income every quarter. One thing or one reason the stock did fall, because if we zoom in and look at this, they fell on earnings. They actually did miss on their revenue, though. So that's one thing do beware of. They did miss on their revenue, but they beat on net income and they beat on their EBITDA. So I wonder what the guidance was as well. We do got to watch the guidance, but this is good news for a restaurant in this environment. Sales up 20%. That's great news. Operating profit, the profits, they had most they had a record profitable quarter this quarter. So everything seems like headed in the right direction. Valuation might still be a little high here. Honestly, a better buy or maybe a safer buy might be Chipotle. That's kind of the bigger version of that company. But yeah, Chipotle is also publicly traded, CMG. Does Moomoo actually give you 8.1? It does it temporarily. Yeah, if you look in the middle of my screen, I get a 4.10% APY. It goes away after a couple months. But yeah, it does JVM. So yeah, what app is that? Yeah, hey, Dark, again, if you want to get this app I'm on, I'll paste it in the YouTube chat. It's in the link tree in my bio, the very first link there. It's my favorite one. It's an affiliate link, full disclosure. Or you can just go on Google and type it into Google. It's just a brokerage called Moomoo. So Mir said super micro stock. I do own this company, by the way. Here's why I think this one is going to go lower. So here's the unfortunate part. If they just sell a commodity, but check out the growth. The sales are up 7.5% year over year. So the sales grew. That's great news. But even though the sales were up 7.5, the net income fell by 34. So that means they're losing their net margins. And this wasn't some one-time adjustment. Like, this was real. They're giving customers bulk deals and it's hurting their margins. So the margin's only at 3.4%. That's why I think this company is going to probably, I'll show you my position. I'm not buying any more of Super Micro until it goes closer to the $35 level. I think it's too soon to meaningfully buy the dip yet on Super Micro, in my opinion. Not financial advice. So yeah. So let's see. The Cloudflare. Let's do it. NET, Cloudflare. Did you know, this is a pretty cool stat, 20% of all global internet traffic goes through Cloudflare in one way or another. So, wow, they're at an all-time high. Great stock. So first off, I have to give them a shout out because this is incredible growth. I mean, the revenue just hits a new record. These year-over-year growth rates are just ridiculous. So the revenue just hits a new record every year, every quarter. That's why they deserve the high premium. Do beware, they are still losing net income every quarter, but it really was from this acquisition, I think, that they did. That's how their assets jumped up by $1.5 billion. But I really like Cloudflare. Very growthy. I do like them. Yeah, here's the investment they did. You can go to the cash from investing activities. If this is negative, that means they're investing in the business. They bought a new asset. They bought a new company. They bought land or something. You want to see this negative. If it's positive, that means they're selling their assets for cash. You don't want to see it positive. So yeah. So Mr. 123 said, honest company. Yeah, let's do it. So, but do you get 4.1% for free? No, you don't, JVM. You don't. Yes, you don't have to pay anymore. That's why I like Moomoo more than Robinhood. With Robinhood, you have to pay $5 a month to get the 4% APY. But let me see down here. Yeah, you have to pay $5 a month to get 4% APY. That's why I like Moomoo more, because you don't have to pay $5 a month and you get a 4.10% APY. So that's why I keep my cash in here. It earns you daily interest. So my $1,000 earns you 11 cents daily. It says 34 cents because it adds up the days over the weekend. But you get paid 11 cents a day for $1,000 on cash. And, and you can spend the money anytime too. Okay, so let's see. Some people I know just get the app for that reason right there. It's better than a bank. They put their cash in here, barely buy any stocks just to earn the interest. So let's keep going here. Yeah, if you want to get the app, it's in the link tree in my bio. The first link there, it's a brokerage. So what was this next one? The Honest Company. Sorry, this company is a small cap. They do just sell a commodity. They just sell diapers and wipes. But look at this market cap. They're a $440 million company. So that's a very small market cap. But here's why this is why they gap down on earnings right here. The business isn't really growing, which is unfortunate. The sales only grew by 0.44%. That doesn't really beat inflation. I think investors wanted to see more growth than just 0.4. Luckily, though, the good news, they are making net income. They made $4 million this quarter, $3 million last quarter, and they have no net debt. So they have like 70 mil of cash, like 10 mil of debt. So they have like 60 million of net cash. So that means legit like 15 or 18% of their entire market cap is just their cash on hand. Pretty cool. Yo, what up, Mushy Unicycle? How's it going, man? So let's see. How about what would be the top stock you'd recommend to buy at right now prices? That's so tough to say. If you go to the very beginning of the stream, you can see my full explanation why. I'd probably buy a little bit of ticker symbol TAP stock. TAP looks very interesting as a dividend growth company. They have a 3.8% yield, low PE. I think I have a conspiracy on why their PE is artificially suppressed. I think they're going higher. Progressive Corp's another good one, and Sprouts Farmers Market. These three stocks right here are the three that I think are at great valuations to buy at right now prices. Because there's a lot of stocks, like legit all these, I wouldn't buy at right now prices, or most of these. Like I wouldn't buy Reddit, Disney, Robinhood, SoFi at these prices. Or the risk to reward doesn't look great to meaningfully buy at these prices on a lot of those stocks, I should say. Yeah. Okay, let's look at Open Door. I'll be quick about this one. This one is begging for lower interest rates because they just flip houses. They're super interest rate sensitive. Housing market, if we go back to what happened last time we were in a zero interest rate environment, 2021, 2022, check out the sales, 4 to 5 bill of revenue a quarter, ridiculous revenue. But then as rates hiked up, you see the sales, they kind of tricked down, minus 70%, 69%. And now it's kind of chilling. And if these analysts are right, this isn't good. Revenue is going to go from 1.5 billion to 540 million. That'll be like the lowest quarter in many, many years. So this company is really excited for a lower interest rate environment. They do still lose net income every quarter as well, but the losses are narrowing thanks to them cutting headcount. Yeah, I wouldn't touch that one at this one. They're kind of momentum-y right now, especially over $5-6. I'd be so careful with that stock. They did just get like a new management, like a new CEO, I believe. So that's cool. What up, Mike? We said thoughts on BSX stock. Oh, then we can look at OPXS. How can you tell when a company is diluting you? Here's how you can do that, John, because there's multiple ways a company can dilute you. But you go to the cash flow statement, you go to the cash and financing activities. If this company is, if this number is negative, that means one of two things. They either issued $233 million of debt, or they diluted you by $233 million by issuing $233 million of stock. Or it's a combination of the both. But as you can see in this quarter, it was negative $340 million. Here's another way you can do that. You can go to the net. Yeah, so so look at this. This was negative right here. So this was all from the net issuance payments of debt. So they paid off $314 million of debt this quarter. So that it wasn't any stock. But anyway, let's go analyze BSX right here. Wow. First off, congrats if you own this company because they are at an all-time high, pretty much. So you got to be up on your position. No dividend on this stock, which is all right. So they're in cardiovascular sales. And check out the consistency of the growth here. Sales are up 25 after going 21, after growing 15. So the growth rate is growing pretty crazy. Then they own MedSurge, also another very nice growthy business. Sales are growing double digits every year. That's very impressive. So both main businesses are growing like crazy. So sales are up by 22, but net income is up 150%. That means they're expanding their net margin. Check that out. Sales went from the net margin went from 7% to 15%. I mean, that's ridiculous growth, and that's how the net income grew at such a fast pace compared to the sales. So anyway, BSX, I can see why they're at all-time highs. That margin expansion. What app are you using? Yeah, hey, this is a brokerage right here. It's a software. It's in the link tree in my bio, the very first link there if you want to get it. It's where you buy stocks. It's my favorite one, lowest fee brokerage, favorite one for analysis. I have Webull and Robinhood, but this one's my favorite one, all in one app. But yeah, it's an affiliate link, full disclosure too. It's in the link tree in my bio, first link. If you sign up and deposit $100, we'll both get a fractional share of NVIDIA for free. So it would help me out. But or you can just type it into Google. It's just a broker called Moomoo. So yeah, let's see. Yeah, no problem, John. So let's see. Why people buy bonds then if they can get the same interest rate with brokerage? So here's the thing. Actually, JVM, great question. Why would someone buy bonds for the dividend when you could get a money market fund that you can't lose capital appreciation. You get the same yield. Well, here's the thing. If you buy the bonds, for example, TLT, you're buying the US 20-year Treasury bond, you're locking in the yield, the 4%, 4.36% dividend yield, but you get the stock price appreciation of the bond with ticker symbol TLT. So here's the thing. When we go into a high interest rate environment, TLT goes down. It's legit like inverse or 1-to-1 ratio. But as interest rates go down, as soon as rates get cut, as soon as we go into a lower interest rate environment, this will appreciate in stock price. So that's why some people like to buy the bond, because you get the yield plus the appreciation of the bond. McDonald's is a pseudo TLT play because of McDonald's really rhymes, sometimes moves with the interest rate sensitive because so much of their market cap is their real estate portfolio. Same with REITs like a Realty Income or a Vici Properties. They're also move with TLT. So someone said thoughts on ACHR. What up, Mr. 123? So Archer Aviation, here's why I'd avoid this stock right here. And I know they're really popular, and this isn't the popular thing to say, but here's why I'm just staying away from this stock right here. If you look in the top right, the market cap, they're worth $5.5 billion. So remember that number. They're a $5.5 billion company. That's a startup. So when we go to the sales, the revenue right here, it says no data because they've never sold anything. They never sold a product or a service. So that's the one thing that does concern me. So they're a revenue-less company that loses a couple $100 million in net income a quarter. They luckily have a great balance sheet and can afford these net income losses. They have $1.7 billion of cash. But if you're wondering, how do they get this cash because they have no sales? Well, you go to the cash from financing activities. Not good. They're diluting you by a couple $100 million every quarter. I don't blame them because the stock was pretty overvalued at $5 billion, $6 billion market cap. But yeah, they diluted you by nearly $1 billion just this quarter to raise up that cash. Also, Stellantis, which owns like Jeep and Dodge, I believe, owns 10% of the shares. ARK Investment owns 5.5%. But yeah, I'm being careful because the fact that they're revenue-less, they're losing net income, a lot of it every quarter. They have a good balance sheet, but remember, they got this beefed up balance sheet because at the sacrifice of you being diluted. So you own a good chunk less of the company now. So I'm being careful. I honestly just wouldn't touch that one. But as soon as they maybe finally have some sales, maybe they'll kind of rally up. Can you explain TLT again? Yeah, hey, Steve, by the way, if you missed anything, if you go to my YouTube channel is called Nathan Robert. You can just type that in YouTube, Nathan Robert. It's also in the link tree in my bio. You can replay it. Yeah, that's the best way to support me, by the way. Subscribe to my YouTube channel. It's called Nathan Robert. I'm trying to build up the stream over there. But yeah, TLT basically, as interest rates go lower, this will appreciate in stock price. So you get the 4.4% yield, which is the same as this, but you get the stock price appreciation when interest rates go lower. If interest rates go higher, that's going down in stock price, and you could lose money. Okay, to explain it kind of simply. So, I have to go in 2 minutes. This is not good. Okay, we'll kind of go really quickly here. By the way, I do have to go in 3 minutes, but I am going to be streaming in exactly 8 o'clock. Wait, 2. Well, probably in 6 hours from now exactly. If you want to set an alarm or just hit the follow button, subscribe button. I'm going to be live in exactly 6 hours from now when the market opens. We're going to be doing this exact same sort of stream. We're going to be seeing what stocks you guys want me to look at, and the market will be open, so we'll see how the market's moving next week. So yeah. By the way, I sell nothing. I have no course, book, Discord, WhatsApp, Telegram. I'll never DM you, follow you. This is my only account. The only other thing I do have is that YouTube channel. I saw someone saying Wolf Speed. Let me pull up this one. So here's why someone kept saying in chat, Wolf Speed becoming the largest something. Here's why you can't touch this stock at all-time lows. And I feel bad if you own this one, but here's why I could never trust my money in this stock. And I'm just going to show you the numbers for yourself, and you could draw your own conclusion. All right, lemon drop, and I'm not trying to call you out here, but did you even know this about the company? Remember, this whole market cap, this is a $195 million company. Remember this market cap. They're a $195 million company that lost $670 million of net income this quarter. So they've lost 3x the entire market cap just this quarter, all for a business that the sales declined by 2% year over year. So legit, this has, in my opinion, a very high bankruptcy risk where it's just going to zero. They now have, more liabilities than assets. We zoom out. They used to have more assets than liabilities. Now more liabilities than assets. I can see why this one's at all-time lows, and in my opinion, it's just going to slowly continue to bleed out to lower and lower all-time lows. So yeah, hey, if you like how I talk about stocks, I'm trying to show you the numbers for yourself. I'm fully transparent. I sell nothing. I just I go to so many other TikTok streams, YouTube streams. No one shares their portfolio. Make sure to hit the follow button, and for y'all on the YouTube stream, hit the like button before you go. I really appreciate that. I do have to go, but yeah, again, I'm going to be live in exactly 6 hours from now. I hope you have a great rest of your Sunday. Thanks again for showing up, and I'll see you guys very soon. Thanks again. And yeah, best way to support me, just go subscribe to my YouTube channel called Nathan Robert. It's also in the link tree in my bio. And if you want to get my favorite little app that I was just on, my favorite brokerage, first link in the link tree in my bio. But just type into YouTube Nathan Robert, you'll find my YouTube. See ya. Have a great rest of your Sunday. See you in 7 hours if you want to come back to the stream. Hey, see y'all later. JVM, Doc, Celebrate, Michael, Taylor, John. See you all in the next stream. Hope you have a great rest of your Sunday.